It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. We've got a jam-packed Monday show for you today. We're getting a number of big tech earnings this week, so we're going to break that down. Results from 5 of the magnificent 7 tech stocks. Investors hoping these reports will bode better for markets than Tesla's massive disappointment. And breaking news on one of those key names, Amazon terminating its deal to buy iRobot. We'll break down what the signals for investors ahead.
And it is a busy week for the economy. The Fed decision on interest rates on Wednesday and the big jobs report Friday as the markets try to game out the start of potential rate cuts. We will see if this data puts a soft landing euphoria to the test. But first, let's get right to it with the 3 things that you need to know, your roadmap for the trading day. Yahoo Finance's Josh Schaefer, Akiko Fujita, and Jared Blickery have more.
Hey, Shauna, investors bracing for a busy week packed with big tech earnings. Microsoft, Alphabet leading the pack on Tuesday. And you've got Apple, Amazon, and Meta all set to report earnings Thursday after the bell. We'll watch for whether or not these tech earnings can drive the market's momentum higher.
Shares of Hong Kong-listed Evergrande closing down more than 20% after the stock was halted overnight. The Chinese property developer received a liquidation order from a Hong Kong court. We're going to break down what this means for China's ailing economy and potential contagion effects in the U.S.
And oil prices moving to the downside this morning as Middle East tensions escalate. 3 U.S. service members were killed and dozens wounded by a drone strike from Iran-backed militants on Sunday. Now, President Biden vowing to retaliate, saying in a statement, those responsible will be held to account. We're going to discuss how ongoing tensions could drastically impact global markets long term.
Well, good morning, everyone. Tech is on deck this week. Some of the stock market's largest technology companies set to report earnings. And for more on how the reports may impact markets, we've got Yahoo Finance's very own Josh Schaefer to help us give the rundown for the week ahead. Hey,
yeah, Brad. So you take a look at that list we just showed, 5 of the so-called Magnificent 7. And when you think about Tesla's performance a week ago, maybe we're talking more of a Super 6 here and not a Magnificent 7. So really, you're only missing NVIDIA in terms of massive tech companies to report this week. And really, guys, I think the story here is understanding how big this is going to be for the overall market and the fundamental story that we're seeing in the stock market. So when you take a look at the earnings projections for the 6 companies, I'm going to say 6 here because we're including NVIDIA in the graphic that we're showing, but they're projected to grow earnings. This is data from FactSet at nearly 54% year over year for the fourth quarter. Look at the other 494 companies. They're expected to have earnings fall 10.5%. So when you think about why stocks move higher, right, and sort of what people are buying, you're buying earnings, right? You want earnings to eventually go up. That is the story of the stock market in the long term. And that's why the short-term story of the stock market has really just been these 6 stocks. This is what we're waiting for. This is the big moment.
This is what we're waiting for. It's a big moment. And then you pair that also with the jobs data that we're going to be getting out on Friday, the Fed decision on Wednesday. I know you closely are following that as well, Josh. In terms of investors' view on this, in terms of the big driver of the market or the key thing that traders are going to be listening for, obviously a lot of that's going to be surrounding the timing of that first cut. But beyond that, what do you think has the potential to move the markets this week?
Yeah, I mean, it seems like overall we're still in the soft landing is probably consensus and probably to the upside, right, as far as what people are expecting. So anything that doesn't give us that when you're thinking maybe a really cool jobs report, perhaps the Fed talking about cutting later than people think or being more restrictive than people think, or I do think the fundamental earnings story from tech because of where the overall S&P is at right now. I did a story over the weekend about the S&P being potentially overvalued and what strategists say about that. Well, they talk about if you really think about what's in the S&P, you're buying future earnings growth, right? And if you get that earnings growth from these big companies, then one could argue the S&P 500 at a record high isn't overvalued and it has room to keep growing. So you sort of get all 3 aspects this week, right? We talk about the Fed a lot. That can move your major indexes and move things. We talk about the Mag 7, we're getting that. And we got a jobs report on Friday, because why not, guys? So I guess we'll talk on Friday, and we'll decide what the biggest mover was of the week. It's the only way to do it.
Certainly setting up to be a very busy week here potentially for the markets. Josh, great stuff. Thanks so much. All right, well, let's stick with one of those top stories, and that is tech. 5 of the Magnificent 7 stocks reporting results this week, and their results could be critical here for the market's momentum. So what should investors expect, and how could this potentially impact your investment portfolio? To break that all down, we want to bring in JJ Kinahan. He's IG North America's CEO. And JJ, it's great to have you on set with us here this morning.
Thanks for having me, guys. You know, it's interesting. I was just sitting here thinking as you guys were talking to Josh, how often is it that you have a Fed meeting and an employment report in the same week, and they're really not the top story? Yeah. It's pretty amazing.
So put that further in perspective for our viewers, right? When we talk about how critical these earnings results are here from 5 of the 7 Magnificent 7 stocks here that we've been talking about ad nauseum for the last 12 or 14 months. In terms of setting the tone here for the markets, what do you think we'll learn this week?
Well, I think, Josh hit it right. You look at their earnings are incredible compared to what's going on in the rest of the market. You don't often see this where a few stocks are just so outperforming the rest of the market, and have really continued to take the rest of the market on their back as we go higher. Now, what I do find interesting is there's a couple of names this week. First of all, there's 106 of the S&P 500 reporting this week, so that's absolutely incredible. Secondly, there are some names outside these ones that we all talk about every single day that I'm looking at this week. You have UPS reporting this week. Why do I care about UPS? You had FedEx talking about a slowdown in consumer shipping and spending. Well, UPS backed it up and say we're seeing a slowdown. We saw this incredible holiday season for consumer spending. Now that the credit cards bills have hit, what's January and February going to look like? And I think that that's something that we really have to continue to watch overall. And we also have GM this week. What are they going to say about electric vehicles? Because that directly affects one of the Magnificent 7, being Tesla. Mm-hmm. We know that they've scaled back on it. So I think that outside these ones that are of course just amazing stocks, perform every day. The AI, I think, will probably be the primary theme in there. There are some other really interesting stocks that I don't think people should overlook this week.
Just as a follow-up on that, is there one specific Magnificent 7 name that's reporting this week that is a bellwether, even among those that are coming forward here, and tells us a little bit more about the economy that investors perhaps need to know?
I think it's Amazon, and the reason I say Amazon is all the different businesses they're in. They have retail, they have media, they have Amazon Web Services, they're developing chips. I shouldn't say actually developing chips, but they're involved in AI, et cetera. All the things that Amazon is involved with. And, I think that sometimes they're involved with so many things, we kind of forget all the different areas that are influenced. So that's one that I think, as a retail investor who I deal with every day, people should just look at the different areas they're involved with and see how they're doing across the board, not just the headline number. That's one where it's probably worth just reading a few paragraphs down on the story and not just the headline.
And JJ, when we talk about investors trying to get exposure here to this market, we have stocks here at record highs. It's also options week at Yahoo Finance, and we're going to be digging into a number of angles when it comes to options and some of the trades that are available out there for retail investors. I'm curious from your perspective and the data that you've been following, what has interest been like from a retail perspective outlet there? And then in terms of what investors should or need to keep in mind when they're considering options, what would your advice be?
Yeah, so first of all, I think the interest continues to explode. Mm-hmm. We see the OCC, which is the Options Clearing Corporation, which clears every single options trade done on an exchange. Retail traders will always trade through an exchange on options. We've seen them continuing to set records. I think the reason is the biggest underrated thing about retail investors is how great they are at managing capital. A professional trader never really thinks that much about the capital they're putting up per trade. A retail trader always thinks, because they have a limited amount of capital. So how much am I allocating to every single trade? It's a really important consideration. The biggest thing I would say to retail traders getting started is stay small to start. I mean, I know I work for a brokerage firm, I'd be like, spend everything. No, but quite honestly, stay small to start. The smaller you stay, you'll get as much, if you're just starting out, you'll have as much pain and suffering in one contract as you will in 10, as you start to learn. Staying small, defining your risk up front are the two biggest things anybody can do to truly learn how the options market works. I traded on the SIBO floor for 21 years, and it was the very first thing that I was taught. Always stay small. The easiest thing in the world to do is to become a bigger trader.
So what with that in mind, has been the most attractive options trade that you've seen?
Well, I don't know if I'll say the most attractive options trade that I've seen. How about this? I'll tell you some of the areas that our clients have been trading in. And, a really interesting one has been Ulta. Very bullish activity in Ulta. Very
Also beauty.
Yeah, Ulta Beauty.
Beautiful.
And well played. And then CVX has also been. And then on the bearish side, we've seen Lululemon, which I found very, kind of maybe odd, and AT&T.
Are you seeing activity in some of these big tech names? You talk about the fact that there's been such a run-up, investors looking for other ways to play it. What are you seeing there?
Well, it's interesting because if I look at our top 10 every day, you're going to see these names involved in there. You guys talk about them every day. They're what's driving the market overall, so people are interested in them. So yes, absolutely. We're seeing a bit of a bullish tinge to most of them. Probably Microsoft has been the one that has been the most bullish heading into earnings.
JJ, great to kick off the week with some of your insights here. Thanks for joining us in the
Thanks
studio.
for having me.
Thanks,
Absolutely. JJ Kinahan, IG North America CEO. Everyone, we're also tracking a story out of Asia Pacific. China's Evergrande is heading to liquidation. A Hong Kong court ruling that one of the country's largest property developers is failing to deliver on its restructuring plan. For more on what this means for investors on this side of the world, Yahoo Finance's very own Akiko Fujita is here. Hey, Akiko.
Hey there, Brad. Yeah, we're talking about a company that was once worth $50 billion. Since then, it has been a dramatic fall from grace for Evergrande on the back of rapid spending and rapid borrowing. We're talking about debt racking up $300 billion here. Overnight, as you said, the Hong Kong court ordering the company's liquidation, sending Hong Kong traded shares of Evergrande halted down to 16 Hong Kong shares you see there. You compare that to the $3.50 it debuted at in Hong Kong back in 2009. So you've seen the significant decline there. The question you pose there, why do investors outside of China care? Well, it is the real estate sector that makes up a quarter of the world's second largest economy. A collapse of Evergrande would likely have ripple effects across the Chinese economy at a time when we've already seen a dramatic pullback in growth. You could argue that's already been happening, and the big concern here is that any collapse could lead to a contagion effect to banks and lenders and lead to a broader credit crunch. Now, with that said, the collapse or the decline of Evergrande has largely been telegraphed since the company defaulted on its debt back in 2021. Then in September, the company filed for bankruptcy in New York. Also in September, the chairman of Evergrande was placed under police surveillance following that. And we've seen that pattern in China with companies that have really struggled in a significant way. Evergrande's question now is whether, in fact, mainland Chinese courts will follow the ruling of Hong Kong courts because they are separate. And of course, what this means for the other big real estate developers out there, mainly those like Country Garden, guys.
And certainly we're going to be talking with an investor guest here in the next hour, just moving that forward, talking a little bit more about what this means for investment portfolios here in the U.S. Akiko, great stuff. Thanks so much. All right, well, shares of iRobot sinking in pre-market trading as Amazon announces that it will not move forward with its acquisition of the vacuum maker. Now, they're saying that they see no path for regulatory approval. More bad news here, iRobot. Take a look at those shares, off about 19% ahead of the open. And also the fact that it is cutting 31% of its staff as its chair and CEO, saying that he will step down immediately. Lots to unpack here. But Brad, let's first start with the Amazon angle of this, because the fact that they are abandoning this $1.4 billion acquisition coming after the deal was pressured from the EU, but I think more so just what this signals more broadly in terms of Amazon needing to defend the fact that it's not a monopoly, that it should be able to get approval for these sort of deals, and what this could mean for other M&A activity beyond Amazon, but talking about some of those other larger tech names, which has been under pressure now, not only in the EU, but also here in the US with the FTC.
Right, and an uncertain future now here for iRobot, especially with some of the restructuring plans that the company has announced as well on the back of it, undertaking the operational restructuring plan, trying to align cost structure with near-term revenue expectations and to drive profitability is what they say. They're reducing some of their research and development expenses by approximately $20 million year over year. They're also looking to have some margin improvements and generation there of approximately $80 to $100 million in savings, not necessarily money that they're going to see just flow in terms of profits. And so that brings you to the larger question as of what their profit base will actually look like. And then you mentioned the restructuring impacting the employees here. 350 employees, 31% of the company's workforce as of December 2023. A lot of those notifications are going to be taking place, unfortunately, by the end of March.
Yeah, certainly. So it's going to likely be under pressure a little bit. And then just going back also just in terms of Amazon, the fact that it needs to prove that some of its actions is not stifling competition elsewhere.
Right.
That's going to be remain a topic here as you look forward to what these big tech giants are going to look like here in several years.
Absolutely. Well, looking forward to what's next in the show. Coming up, SoFi surging on the back of its results, and Jefferies reiterating its bullish stance on Snap. Yeah, the brand of Ghostface Chilla. We've got the trending tickers on Yahoo Finance next.
Novo Nordisk is a Danish multinational company that has built itself into a force in the weight loss industry and, by some accounts, created an obesity market out of thin air. The popularity of its blockbuster obesity drug Wegovy and diabetes drug Ozempic for weight loss was so great that it has been credited with propping up the entire economy of Denmark. It is that impact and buzz that led Yahoo Finance to name Novo Nordisk its 2023 Company of the Year. Novo's gross profit in 2023 was nearly $26 billion, or almost a 27% increase year over year, and the stock is on a tear, up more than 50% in the past year. The company began double-digit profit growth in 2020. So let's look at what started Novo's boom with Beyond the Ticker, where we take a closer look at some of the company's biggest moments. Novo's origins trace back to 1923, when Nordisk Insulin Laboratorium commercialized insulin that its founder brought over from Canada. 2 years later, two employees broke away to form a rival Novo Therapeutics Laboratorium. Nearly 5 decades later is when Nordisk first established its presence in the United States, and in 1985 launched the NovoPen, the first insulin pen device. 4 years later, the two competing Nordisk and Novo entities merged to become the present-day giant and the world's largest producer of insulin. The company finally shifted away from its reliance on insulin revenues in 2017, when the FDA approved Ozempic for diabetes, and subsequently to treat obesity in diabetic patients in 2021. That was the same year Wegovy was approved for weight loss in obese or overweight adults without diabetes. These two products launched a new era in GLP-1s, which have been around since 2005. Since 2020, Novo has been on an acquisition spree, shelling out more than $7 billion on diabetes and obesity biotechs, fortifying its lead in the brand new obesity market.
Time for our trending tickers. SoFi shares skyrocketing in pre-market after the company posted its first ever quarterly profit. SoFi is also projecting 20% to 25% compound revenue growth between 2023 and 2026. There you're taking a look at your screen, some of the actuals versus the estimates and what the street was looking for. They beat on both the top and bottom here. And ultimately, the company also noted that lending products actually increased 24% year over year to 1.7 million products. They said it was driven primarily by continued growth in personal loan products, as well as a notable increase in student loan products, too.
Yeah, Brad, when you take a look at these numbers, the lending segment really sticking out to me because following up on what you were just saying, some of the jump that we did see, personal loan origination, putting a number on it, the volume there was up 31%, up 95% for student loans on a year-over-year basis, and up nearly 200%, 193% for home loans from a year ago. So yes, they are seeing tremendous amount of strength or surge in loan volumes, obviously being reflected in these better than expected results that we're getting here from SoFi. And then deposits, putting a number on that, increasing by nearly $3 billion, and customers now more than 7.5 million. So certainly we are seeing a lot of that optimism reflected in the stock price here this morning with gains of nearly 15% ahead of the open.
Yeah, there was one other announcement that actually came out in tandem with this report just after the actual earnings had crossed the wire. They had made an announcement about a new personal finance company as well, SoFi Invest. And that's going to be particularly interesting because that gives them another perhaps line of business segment for investors to look across for this company going forward from here. 6,000 mutual funds, and it sounds like there's at least some team up with specific kind of venture funds. ARK, Kathy Wood will be happy to know, and perhaps had already been in discussions anyway. But it's going to be interesting to see how many people flow into that product as well, and what that means for the returns for SoFi itself, too.
Yeah, and SoFi looking at what they are saying, break down the barriers there by offering some of these alternative investments. All right, let's take a look at Snap, because out this morning is Jefferies with the call reiterating their buy rating on the stock, saying that there's a lot to like ahead of Snap's earnings results next week. Now, Jefferies making the case that the company is going to see a return to spending from large advertisers here. That had been a big question for Snap and a lot of its rivals heading into this earnings season, what exactly that ad money is going to look like in terms of demand. But Brent Thill over there saying that he sees earnings per share coming in at $22 per share. That's a 12-month price target, which would be up about 35% from current levels. And that comes after the massive run-up that we have seen in the stock over the last 3 to 6 months. They did some channel checks here, and what stuck out to me was one of the digital ad agencies that they spoke with that's responsible for about $1 billion in ad spend, saying that the amount of money that's being allocated towards Snap is increasing from the mid to high teens on a year-over-year basis. So the kids, they love Snap, and the brands are seeing even more money or more reason to allocate more money there to that name.
It's kind of remarkable, the turnaround story, at least in sentiment right now, that we're tracking with Snap. And we have to remember that, I mean, for this particular analysis that had come forward, they had actually recently kind of turned positive on Snap in late November. They note this within their report as well. And over the last few months, you talk about the digital ad checks, but this stock, they believe, has the upside to about $22 a share, 35% upside from current level, and then also sustainable mid to high teens revenue growth over the next 5 years. You got to wonder how that trickles through to Snap and their own growth ambitions. Do advertisers stay for the long term? Do teens and Gen Zers continue to spend more time on the platform, thus making those ad spends more valuable for Snap at the end of the day as well?
Maybe it's no longer going to be a topic of discussion here whether or not it's a takeover target, because that's also been in the rumor mill too, but we'll see whether or not their business continues to strengthen here. All right, well, it's time for our stock to watch, and we're taking a look at American Airlines. Citi, the latest company to upgrade American Airlines from neutral to buy, hiking its price target to $20 a share. Yahoo Finance's Madison Mills on the floor of the New York Stock Exchange with more. And Maddie, why do you think Wall Street's turning a bit more bullish on American?
Well, it's all about a diversified revenue stream for American Airlines, as well as an increase in demand for its pricier tickets. Now, analysts that I've been speaking with since really the COVID slowdown that we saw really hitting the airline industry have been saying that the area to watch for recovery would be those first class tickets, which are really heavily impacted by business travel, which we've obviously seen a big slowdown in. If you're putting your air ticket on the company card, you're more likely to level up to first class, and that's exactly what we're seeing with American Airlines. This came, by the way, this upgrade after a huge beat on their top and bottom lines when it came to their earnings report last week. Now, I should say that we're still, if I look at the Yahoo Finance platform, we're at about a 38% hold on American Airlines, but still increasingly seeing some more buys on this name. And that might be why we're seeing a little bit of green on the screen for American Airlines this morning. They're up about 1.6%. And this story for them is going to be critical given some of the challenges that we've seen in the broader airline space. Ryanair this morning reporting some mixed results, saying that the demand picture is not going to be as strong for them. They're also saying that they're happy to pick up any Boeing aircrafts that other airlines are sloughing off. All of these names are in the green this morning, so seeing a little bit of recovery across the airline space after the past couple of weeks of volatility in the airlines ticker space.
All right, Maddie, we're going to continue to track every movement there later on this morning. We're going to be taking a closer look at JetBlue, Spirit, what potentially could happen if that deal unravels. All right, thanks, Maddie. Well, coming up, we've got the opening bell on Wall Street on the other side of the break and taking a look at futures ahead of the open. A bit of a muted reaction here as investors gear up for what is going to be a very busy week for the markets. We've got more for you when we come back.
And that's a live look at the opening bell on Wall Street. You got Rob Gronkowski, who was up there, and a lot of fan hands down there at the NYSE for Flutter ringing the opening bell, ticker symbol FLUT. And you've got a live look at the Nasdaq in Midtown Manhattan as well. We've struck 9:30 a.m. Eastern time. We've got team coverage of the biggest market movers following the opening bell on Wall Street. Here's a quick look at the U.S. major averages, and we do mean quick. Let's toss things on over to Yahoo Finance's Madison Mills on the floor of the New York Stock Exchange.
Yeah, guys, I'm just taking a look at the market action so far today. It's more of what we saw this morning, which is relative flatness. We're seeing green, but just barely across all of the major indices. Also, I want to talk about some of these big tech names because we are starting to see a bifurcation in the performance of these top 7 names. It started with that miss from Tesla last week. They are actually the biggest gainer, though, in today's trade when it comes to the Magnificent 7. But it leads to this broader question that I've been having. When you expect 20% growth constantly from these Magnificent 7 names, and they're not able to deliver on that, it causes this multiple compression, and that's what we're seeing in some of these names, particularly with Tesla last week. We're seeing NVIDIA, Meta, Apple, and Alphabet in the red today. The other 3 in the Magnificent 7 are in the green, but I want to look also at the S&P equal weight versus S&P cap weighted index, because everyone's been saying, JP Morgan reiterating this morning that if you want to take on a little bit of risk, you can get it in the S&P equal weighted index. But we're seeing that has given back all of the gains that it had over the cap weighted index since November. And that is an indication that these tech names that we're going to hear more from this week continue to drive this market.
Certainly is, Maddie. We've been talking about that all morning. We're looking forward to those results here. And they all start tomorrow, actually. So certainly a massive week here for investors. Madison, thanks so much. Let's kick it over to Jared Blickery with a closer look at some of the movement that we're seeing across the globe here. Jared.
Yes, thank you, Shauna. And we're not seeing too much movement in the indices. The Russell 2000, the small caps, just slightly in the green. The other 3 majors, they are in the green. Let's take a look at the sector action first. We got consumer discretionary and tech. Those are each up 0.25% in the early going. Also, staples and healthcare are outperforming the S&P 500. To the downside, energy taking the rear spot, the caboose down about 0.6%. Communication services also looking a little bit weak. Here's the Nasdaq 100. So mixed picture with respect to the mega caps there. Not seeing a whole lot of outsized movement. Let me just take this opportunity to get to the S&P 500 and a bigger picture view. This is the ICE B of A Move Index. Let's get to the S&P 500 there. Ryan Dietrich is noting that we have incredible 3-month strength here in the majors. So with a little rally the next 2 days, that's into the end of the month, S&P 500 will be up 19% in 3 months, and that's off the October 27th lows. This is going to fire up your favorite bull, that would be Ryan Dietrich, but I found 17 times where the market was up more than 19% in 3 months. It was higher a year later, 16 times for an average gain of 34%. So lots going on, lots to contemplate there. I did want to focus on volatility for a second. We got the VIX is pretty low right now, 13 handle, that's pretty low. And the ICE B of A Move Index, this has dropped to a multi-month low. You can't necessarily see it right here. There you go, got that little print. This is good for stocks overall, and especially the growth stocks. So this is potentially another tailwind for stocks as we head into a very potentially volatile week, guys.
Yeah, big week, a lot of earnings and economic data that the markets are going to be digesting. Jared, thanks so much for teeing up today's trading activity for us. Well, Stifel, TD, Cowen, and Morgan Stanley all getting off the Norfolk Southern train. The 3 firms, they're issuing separate downgrades on the rail company this week. Both TD and Stifel saying they don't expect margin improvement this year, and all 3 say NSC is trailing its competitors. This comes after the company cut 7% of its management and staff last week. We were tracking shares of NSC. They are down by about 1.3% right now.
Yeah, certainly, Brad. And I think this just points to the fact that Norfolk Southern is going to have a challenging several months and several years potentially ahead of them. And that was my takeaway from these 3 notes, and also really follows what we heard from Norfolk Southern when they did report that week of guidance here. They are still clearly suffering from that derailment just about a year ago. Now, they have invested heavily in safety. They've invested heavily in tech in order to hopefully in the future avoid these types of situations. But it is still reflected in the costs that continue to grow here for this company, their profit falling over 30%, and TD Cowen really making the case that this is a name that will likely, because of all that, continue to lag many of its peers here for the next 2 to 3 years as they do try to right the ship a little bit.
Yeah, part of the righting the ship effort is going to have to move through some of the dicey situations that are on the East Coast that Stifel points out. The outlook for ports on the East Coast in 2024, murky, they say. Disruptions in Panama Canal and the Red Sea that could be further heightened by a looming dock worker strike. So that on the docket here, and Norfolk Southern specifically, for them, these disruptions, Stifel says, could have far-reaching impacts of the peer group. The most intermodal exposure this company has, representing over half their total volumes right now.
All right, well, let's move on to a big story that investors, Americans, are clearly going to be tracking over the next several months, and that is the 2024 presidential election. It is a key focus for investors, with a Trump versus Biden rematch seeming more and more likely. But what does either outcome signal for the global markets? We want to bring in Peter Oppenheimer. He's Goldman Sachs' global equity strategist and head of macro research in Europe. And we're also joined by Yahoo Finance's executive editor, Brian Sizey. Great to have both of you. Let's talk about what exactly this election could potentially mean here for the markets, Peter. And I think more broadly speaking, is Trump or Biden, is one candidate viewed as a better alternative here for stocks?
Well, I think the first thing, and thank you for having me, is to say that, of course, we have a lot of elections this year around the globe, the most important one being the US. And one thing that's interesting, despite the potential volatility that could bring, is that implied volatility in the equity market is really very low at the moment, to the point that you mentioned in your earlier remarks. So I do think that we are likely to see more volatility in equity markets as we move through the year and the elections, and particularly in the US, become more relevant. And obviously, the US election will have a big impact on the global economy, in particular because of its impact on possible trade policy. The potential Trump administration bringing blanket tariffs across the board of products bought into the US would have a much bigger negative impact outside of the US, of course, than in the US itself. And I think that will be the major focus of investors in other markets this year.
Peter, Brian here. We've been talking to a lot of folks that are cautioning against, another potential Trump presidency maybe not being as good as investors as the first presidency was. Of course, you had those tax cuts under President Trump. Do you think a second presidency would be more challenging for investors, just given some of the things you outlined?
Well, I think, Brian, you raise a very good point. I mean, one of the reasons why the equity market, as you recall, rallied so much after that last election was the expansion of tax cuts. And there was more fiscal room to do that then than is the case now, given that the budget deficit is so much bigger and US government debt is much higher. So there's less room, really, to repeat the scale of the tax cuts that boosted the stock market so much last time. That being said, it's unlikely that you'll get fiscal contraction under either outcome, and maybe more focus on regionalization and building up manufacturing again in the US, which might be supportive for US companies, but again, less so for companies trying to sell into the US market.
Peter, would you say is the current status of kind of international trade, where the U.S. needs in those next 4 years of any term to position itself? And of the two candidates, where do you see actual movement forward?
Well, I think I don't think there's a very big difference on this regard with either candidates. I think the general pattern here is one where the globalized process of world trade that was really the dominant driver in the last 15 or 20 years is beginning to reverse to some degree. And this is reflecting the rise in geopolitical tensions, also the realization after the pandemic that complex globalized supply chains may be less reliable moving forwards. And in addition to that, things like decarbonization is forcing more focus on regional or domestic production. So I think under either circumstances, it's likely that we're moving into an environment where there's less expansion of world trade. And therefore, it really matters a lot what the domestic growth rates are in these different parts of the world.
And Peter, against this backdrop, you're out with a new book. Congrats on that. I believe that is your second book. Congrats on that one. And to me, the vibe, just reading it, Are There Any Happy Returns is in fact the name of that book. The vibe for me is that investors should almost get outside of perhaps this focus on politics and maybe interest rates and really lock in on what you're calling super cycles. So what super cycle do you see emerging over the next decade, and how do investors make money on it?
Well, thank you for emphasizing the book. Yes, what it really is saying is that investors should perhaps focus less on what's urgent, like the near-term prospects of inflation or interest rates, and that really is the cycle, and indeed is moving in a positive direction as we expect inflation to come down and interest rates to follow this year, and really focus more on the important longer-term structural issues which create these super cycles. And there are some challenges, I think, that we have to look forward to. One of them we've just been discussing: less globalization, more regionalization, more repetition of supply chains. That means higher costs and less margins for businesses. We're also in an environment where we're not likely to see interest rates trending downwards consistently over the next few years, as we've seen in the last decade or two. And that means probably a higher cost of capital and lower returns. But at the same time, there's some very exciting developments to focus on as well. The combination of the impact of things like AI on the one hand, which ultimately could boost productivity, and at the same time, the significant changes that are likely to emerge as we move towards a more decarbonized, greener energy policy. And that's going to create a lot more jobs through more investment in clean technologies and clean energy.
Yeah, Peter, digging a little bit deeper here into the technology and AI point that you were just discussing, I think more specifically, how do you see that impacting returns here going forward? Maybe not so much in the next 2 to 3 years, but more so on a longer term timeline. And when it comes to what investors should do then to best prep their portfolios or position them for that, what would your advice be that investors should consider today?
Well, I think both of these factors are going to be very important drivers of the global economy in the next decade. Insofar as AI is concerned, on the negative side, you've got the prospect of some job displacement. I mean, after all, AI, ultimately, if it's going to boost productivity, will do so by taking some jobs. But the positives are that I think it will boost productivity. And you'll start to see companies outside of the technology sector starting to leverage and employ these technologies to become more efficient and create stronger growth. There are many sectors where this could have a positive impact. Healthcare is a very good example, where large data analysis can help to speed up drug discovery. In terms of decarbonization, the cost here, or the near-term constraints, are really how much it's going to cost to reconfigure our economies and to build the necessary renewable networks and infrastructure and the investment to improve environmental technology. But again, the longer term benefits will be that the marginal cost of energy will come down significantly. So I think investors should look at both of those areas as broadening out the possibilities for companies that can work towards utilizing these drivers, who can help facilitate the move towards a decarbonized economy because they're likely to see stronger long-term growth, and what companies can really utilize new technologies and things like AI to become more efficient, to create new products and services. And those are two areas that we're very focused on.
Some really valuable insights there. Peter Oppenheimer, Goldman Sachs global equity strategist and head of macro research in Europe, alongside Yahoo Finance's executive editor, Brian Sozzi. Thank you both.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Further fallout for Boeing this morning. The Alaska Airlines 737 MAX 9 jet, which had its door plug blowout mid-flight just over 3 weeks ago, appears to have left Boeing's factory with bolts missing. That's according to the Wall Street Journal. Now, airlines are dealing with the ramifications of the incident, including delivery delays. Boeing has halted production expansion for the 737 MAX 9, and United is now reportedly in talks with Airbus about purchasing jets, which could replace an existing order of Boeing 737 MAX 10 jets. For more on the fallout, we have Connor Cunningham, Melius Research Director. Connor, great to have you here with us this morning on this matter. How perhaps expediently do you believe a lot of the airlines are shifting their conversations about future orders as a result of the 737 MAX 9 issue?
Thanks for having me. So I think that what the airlines are trying to do is just, have a potential plan in place if the MAX 10 is potentially delayed for a longer period of time. So, when you look at United specifically, they have they're very much committed to Boeing over the long term with the 787 and the MAX aircraft. But they need in the immediate near term and in medium term, they need to figure out how to find additional lift to kind of hit their plans. This entire environment for the airlines has really been about capacity constraints overall. When you look at the Spirit and JetBlue transaction, very similar in the sense where JetBlue wanted additional lift. And if you had to go to an OEM and order new planes, it's going to take a long period of time. So it's about trying to figure out how you're going to grow in a really constrained environment. If you're able to grow, you potentially are a winner. So that's why, United's trying to look for remedies around potential delays coming from the MAX right now.
Colonel, let's talk a little bit more about JetBlue and Spirit, because JetBlue obviously saying that it could scrap this deal if that in fact does happen. Talk to us a little bit more about the implications of that. Obviously, it would put Spirit in a pretty tough spot, but what does it mean just for JetBlue's ability to compete here with some of the larger airlines?
Yeah, so JetBlue's already, they have their own issues with the GTF grounding. Spirit does as well. But a lot of these growth carriers, the smaller ULCCs out there, have had their models under pressure during the resurgence in travel demand. Historically they used to grow 10 to 20%, and they were able to kind of outgrow their cost structures. Now there's been a lot of cost convergence out there as growth has slowed. So what is JetBlue going to have to do post transaction? My guess is that they're going to need to shrink a little bit. They've already talked about reducing some routes on the edges. They're potentially looking for early outs with employees, so they're probably going to be smaller. Spirit's probably going to need to be smaller as well as they look to kind of concentrate around the markets that have made the highest returns. So that's probably not what the judge wanted when he initially ruled in that favor, but it's kind of the environment that they're dealing with at this time.
Connor, do you think Spirit's going to be able to survive?
It's a really good question. Bankruptcies take a long period of time, take a long time to kind of play out. When you look at just the fleet itself, they have like over 200 aircraft. The vast majority of those planes are leased. We're in an environment where we just talked about all these capacity constraints that are out there. So if you're a lessor, you're potentially maybe looking to reallocate those assets to somewhere else where you can make a higher return. So, Spirit, again, has a model that is really levered to leased aircraft. Even the aircraft that they do own, a lot of it has debt financing behind it. So again, they're going to have to continue to raise capital to go forward and survive. So I'm not saying that they're going to do it, tomorrow, but it's something that they really need to. That the environment's really working against them right now, and they got to make some hard decisions going forward to survive. So we'll see how that plays out in the weeks to come.
Do you think Frontier is still somewhere out there waiting in the wings?
Maybe. It's certainly. They were the ones that wanted to do the transaction to begin with. They're probably not rushing to do something right now. Definitely looking at kind of what Spirit's going to look like standalone. My guess is that they're in no rush, but again, the people that are behind Frontier, have historically been behind Spirit as well with the Indigo partner private equity guys. So we'll see how it all plays out, but they definitely could swoop in. That transaction to us makes a lot more sense than the JetBlue Spirit one did. Again, models are very similar from what they're trying to accomplish. Again, it's all about growth and being able to kind of push growth at potentially lower prices relative to the industry as a whole. So we'll see how it plays out. Definitely something that could happen though in our view.
Kind of, let's talk cruise lines really quickly. You cover Royal Caribbean, and I bring that up because there's lots of talk this morning about Icon of the Seas, the largest cruise ship. I know you attended the launch event. My question to you, though, is this going to be the trick or the ticket here for cruise lines to get more people to board these cruises?
Yeah, so yeah, we did attend the Icon of the Seas event. It was quite something. Again, that ship is obviously very nice and huge. The one thing that, from our standpoint is that, yeah, it's a really niche industry at the end of the day. There's about 30 million people that travel on cruise ships. So they're all about not necessarily fighting with one another about the incremental traveler. It's about, taking some demand away from land-based vacations. When I think about just the cruise line industry as a whole, historically they used to be at a discount about 15% in terms of price versus, a Disney vacation or a Las Vegas vacation. Now it's about 30 to 35%. So they got an opportunity to continue to price up going forward. Ships like the Icon of the Seas should bring a lot of optionality for people. You attach that to a potential, a day at Coco Cay. It's a pretty nice vacation, and it hits a lot of it checks a lot of the boxes that I think people want to go on. My kids loved it, so it's obviously very family friendly type of vacation.
Looks like there's a heck of a lot of activities on that ship. I think any kid would absolutely love being on that. All right, Connor Cunningham, great to have you. Thanks so much for joining us here this morning.
Thank you.
All right, we've got much more market action ahead, and we will take a look at what's happening in the discount retailer space. A note out from JP Morgan. More on that when we come back.
JP Morgan upgrading Dollar Tree. The firm seeing investor opportunity in the space. We've been tracking shares of DLTR and as well. Here's the rating up on your screen. $157 is the new price target here. They dive into a few things here. And one of the things that they're looking across of many in this note is product mix. 48% leisure, 29% fashion and home, 23% party and snack mix. Like the management talking about this particularly here, they're looking across this business and trying to just figure out, all right, where are within the market more broadly the best opportunities for investors to consider, and in the particular segments within retail, Dollar Tree rose to the top of the ranks here for them.
Yeah, exactly. They see some upside here for 4Q same-store sales for Dollar Tree. They see that as an outperformer here within the broader discount category. And I think this all comes down to consumer and consumer spending trends, because within this JP Morgan report, they do lay out a number of factors which could boost spending here for those ages 62 and older. A lot of that because the cost of living adjustment here and exactly the lift that could potentially provide. But those under the age of 62, JP Morgan going on to say that they see about a $10 billion headwind on consumer spending in 2024 for individuals under that age of 62. So because of that, consumers are going to be faced with some tough choices. They are going to be looking to save on items that they are purchasing. And because of that, discount retailers like Dollar Tree here best positioned or better positioned within that type of a macroeconomic environment.
Yeah, and just to clarify what I was mentioning earlier, that is those areas are some of the exposed areas as a result of what's taking place in the Red Sea right now. And so that was the categories that they were looking across, but specifically as it relates to discretionary spending, they note by banner, Dollar Tree's mix is 51% discretionary. Banner reporting 41 to 43% of total retail value purchases, and import point of entry consisting of about 40% East Coast there. So ultimately here, we'll see how Dollar Tree is able to kind of navigate through and past some of the exposure that they do have. But JP Morgan, very, very positive on them this morning.
It's certainly a tough environment right now across the retail landscape. All right, keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
Hey there, welcome back to Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. Stocks, they are higher as investors await results from 5 of the Magnificent 7 this week, as well as a policy decision from the Fed that comes Wednesday, and then on Friday, the jobs report. Get hype.
Certainly it's going to be a busy week. You got to keep paying attention here because really any day or every day could be a potentially market moving scenario. So let's take a look at the individual movers here this morning as we kick off the week. Hershey having a sweet day after Bernstein saying that the company sees market share and volume trends improving. Now the analyst upgrading the stock to outperform, saying that Hershey's innovation is allowing it to lap and stay competitive here with some of its rivals.
And Colgate-Palmolive also feeling the love from Wall Street as Raymond James upgrades the stock following impressive fourth quarter results. The analysts saying that they see potential for the company to continue driving sales growth ahead of its long-term targets as it sees opportunity in emerging markets.
Global payments company Flywire soaring this morning. Morgan Stanley saying it's optimistic about strong growth drivers for the company. Now the analysts there upgrading the stock to overweight, saying that they expect new customer acquisitions to boost revenue and also help margins.
Well, oil prices are lower as conflict in the Middle East escalates. 3 U.S. soldiers were killed and dozens wounded by a drone strike from Iran-backed militants on Sunday. President Biden vows to retaliate, saying in a statement that those responsible will be held to account. As for Iran, the nation's foreign minister is distancing itself from the attacks, saying that accusations of Iranian involvement are, quote, baseless. With tensions flaring, what can we expect the fallout to be for the U.S.? We've got our very own Rick Newman tracking this story. Rick, what do we know so far?
Well, this crosses a so-called red line regarding U.S. involvement in everything happening in the Middle East, because we now have American service members who have been killed and others injured by what appears to be a strike emanating from Iran or with Iran's backing. And President Biden very quickly said, he left no doubt about it, he said, we shall respond to this. Now, the whole question is, what is the United States going to do? There's this chorus of some Republicans on Capitol Hill saying President Biden needs to attack Iran directly. I would not necessarily expect that to happen. Biden, for what it's worth, has been pretty measured in the way he has responded to various types of provocations globally. I mean, we've seen a very incremental response to the war in Ukraine, for example, where Biden gradually provided new weapons. So markets actually seem somewhat reassured by this. We did see a little spurt upward in oil prices after news of this first came out, but oil prices have since settled back, which seems to be the market saying, we don't necessarily think this is going to escalate in anything that will threaten global oil supplies. But there is a slippery slope problem here. I mean, United States keeps getting a little more involved, and it's not clear where this ends.
Yeah, certainly. President Biden vowing here to respond. And of course, Rick, like you were just talking about, the question is how exactly that is going to happen. And if it is any sort of escalation, then more broadly speaking, the risk that this could pose here to the global markets. Rick, always great to get your insight. Thanks so much.
See you guys.
All right, well, shares of Hong Kong listed Evergrande closing down more than 20% after the stock was halted. Now, a Hong Kong court ruling that one of the country's largest property developers is failing to deliver on its restructuring plan. For more on what the potential ripple effects mean for U.S. investors, we want to bring in Dennis Unkovic. He is a partner at Meyer Unkovic and Scott. Dennis, it's good to have you here. So when we talk about the issues right now, the China's property crisis obviously continues to drag on. Put in context just the risk that this poses here for global investors about the fact that, hey, maybe the worst isn't over for China.
Well, Shauna, the Evergrande at one time had $300 billion in debt, so it went in bankruptcy in 2021. Since then, it's been fighting to stay out of bankruptcy. Since then, the courts have said to the creditors, please, can you settle this? The answer is no. I think the judge said this morning, enough is enough. And so she said, we're going to have this company liquidated. The big problem, Shauna, is that if it was just one company, you wouldn't really care. But it reminds me a little bit of the Lehman Brothers moment. When Lehman Brothers went down, there was a question about how it would spread. You have other companies like Evergrande, for example, Country Garden, that have similar debts. Country Garden is now the largest private real estate company in China, and it has similar problems to Evergrande. So the problem is it isn't over, and it really may just be beginning.
The coincidence of timing as well here, Dennis. I mean, they're trying to stimulate the economy in China right now. So what is the significance of that timing, this taking place in the liquidation at a time where they're trying to put more liquidity into the system?
Brad, this couldn't come at a worse time. What the Chinese government really, going back 3 years, has said, look, we don't want any more private lending to these companies. But in China, they have something called shadow banks, and they are sort of like non-regulated banks that lend money. Well, they lent a lot of money to Evergrande and then Country Garden. And then as they got in financial problems, it really got worse. And so as the Chinese government, the Bank of China is saying, I'm going to loosen up the requirements to buy a house or to make an investment. But really, I think China at this point is doing too little. Whether it's too late or not, I don't know. But the Chinese government is taking this seriously, but it hasn't taken a major step. One other thing, if I can mention it, the Hong Kong court has said, bankruptcy, okay, you, the creditors, can execute. But most of the assets, Brad, are located in China. The question is, will the courts in China enforce this order from Hong Kong? Although Hong Kong is part of China, the question is, will they attack or essentially allow these assets in China to be taken over by the liquidator, the person who runs the bankruptcy? The answer is, I really don't know. But if I'm a Chinese official, I'm worried.
Well, Dennis, exploring that a little bit more, and I know you briefly mentioned it, it's tough to tell right now. There is so much uncertainty, but do you think it is too little, too late?
Yes.
So then what?
I can give you a longer answer, but the Chinese, this is probably $1 trillion problem for the Chinese. And what Xi Jinping doesn't want to do, I think, is to say, okay, if there's a problem, the government is going to bail out these private companies, because that's really against what the Chinese party wants. They essentially want control over things, but they don't want to bail out private industry. And so it really couldn't come at a worse time, Ishana.
And Dennis, then bringing that back here to the U.S. and discussing the geopolitical relations aspect of this, China obviously a hot topic here heading into the 2024 election. If we do get a Biden-Trump rematch, how do you think Beijing is thinking about the outcome here in the U.S. and what that relationship could then mean for their economy and their markets here going forward?
I don't think the Chinese can figure out any better than we can what's going to happen, Biden versus Trump. But what's clear is that the American economy is, booming's the wrong word, but really going in the right direction. The Chinese economy is going down. It's actually at the lowest point it's been in the last 25 years. And so I think they're worried about how a decreasing economy in China is going to affect their ability to do business around the world. And if I'm an investor and I'm looking at China, I'm going to be extremely cautious at this time about putting any more money or investments into China.
Further along that thought, if you're an investor and you're looking at China and trying to game out which companies are most impacted by what's taking place both on a larger level, but specifically within the Evergrande issue here now and the liquidation, I mean, are we talking industrial stocks, Caterpillar? Who are the most exposed from your perspective here?
Those companies that are selling hard goods to China now, and it goes across a broad range, they are directly affected by the health of the Chinese economy. To put this in perspective, about 25 to 30% of the Chinese economy is dominated by real estate. And as we've just said over the last few minutes, that's getting worse and worse. And so if you're at all playing into the real estate market and supply, you should be worried. Other thing is that if you are sole sourced out of China for anything, I think you need to really seriously look about an alternative source, not necessarily not doing business in China, but saying to yourself, do I really want to be so exposed there? Look at Apple, how many things they're making there that we all have in our pockets here right now in China. A lot of them being manufactured there. I'd take a serious look at that if I were they.
Dennis, great energy, great context and insights here. Dennis Unkovic, who is the Meyer Unkovic and Scott partner here. Dennis, appreciate the time.
Thank you, Brad and Shauna.
You got it. Guys, coming up, all eyes on more economic data out this week. Economic? Well, it's out this week. We're going to take a look at the jobs report and Fed decision next.
From iPhones and iPads to Macs, Apple Watches, and AirPods, Apple's products are a daily necessity for millions, and the numbers prove it. The company generated more than $394 billion in revenue in 2022 alone. But how were they able to achieve such staggering success? Beyond the Ticker charts its path to becoming a tech giant. Steve Jobs and Steve Wozniak founded Apple in Los Altos, California in 1976. That same year, Wozniak built the company's first product, the Apple I. Apple debuted the Macintosh with its now iconic 1984 commercial during Super Bowl XVIII. The Macintosh stood out because it was the first mass-market personal computer to feature a graphical user interface and mouse. Jobs left Apple after his famous falling out with CEO John Sculley in 1985 and subsequently founded the Next computer company. In 1991, Apple introduced the PowerBook line, which set the standard for most modern laptops. In 1996, after a run of CEOs, Jobs returned to Apple. The company purchased Next to use its operating system and named Jobs interim CEO in 1997. Apple introduced the iMac in '98, and the line would go on to sell millions of units. 3 years later, Apple debuted its first iPod, which could store roughly 1,000 songs. And that same year, the company opened its first Apple stores. But it was in 2007 that Apple unveiled its most important product of all, the iPhone. A revolutionary device, the iPhone helped create an entire business model around apps and the App Store. Jobs suffered from pancreatic cancer towards the end of his second term as CEO. He resigned from the company just before his death, and Tim Cook took over as CEO in 2011. In 2015, Apple took the wraps off of its first new device since Cook took over as head of Apple, the Apple Watch. Just 7 years later, Apple became the world's first publicly traded company to reach a market cap of $3 trillion. And in June 2023, the company unveiled its most ambitious product yet, the Vision Pro. A mixed reality headset, the Vision Pro is scheduled to launch in early 2024.
Stocks muted this morning as investors brace for a big week ahead, including January jobs numbers and the latest rate decision from the Fed. Let's bring in Lakshman Achuthan, who is the Economic Cycle Research Institute co-founder, to discuss what you should be keeping an eye on. Great to have you here, back with us in studio here. So, of the top things investors should be watching over the course of this week, what is the key economic data point that is perhaps going to tip the scale one way or the other?
Right. For macro data, it has to be the PMIs. So these are surveys of managers. What are you up to? What are you feeling?
That's not the sexiest data point to call out, by the way. Let's just put that out there.
Purchasing managers. And then the jobs report. That's the big one at the end of the week to get the tone the flavor of kind of where are we in the jobs report, where there's been headline jobs growth for a long time, right? An amazing amount of time. It has been slowing since 22. And it's a very clear downtrend in the headline growth. And underneath, there's some things that are looking a little weak. So that's a close one to watch.
What's looking more specifically a little bit weak in terms of the underlying data? Because we focus so much on those headline numbers there. What are some of the trends that you've noticed? And then how do you think the Fed is going to view what seems to be the most likely case, at least consensus right now, that maybe jobs are going to cool just a bit, but it's still overall going to remain pretty resilient?
Yeah. So let me unpack that. I'll give you the good and the bad. Which do you want first?
Give us the bad, and then we'll take the good.
And then we'll end with the good.
Yeah.
Okay, so on the bad, weekly hours.
Yeah.
So we're hired, a lot of people are hired, but their hours are going down, and they've declined in a way that you typically see around a recession. So this is a situation of employers feeling the demand softer, but not wanting to let people go. So they adjust the hours. Then we look at things like the kinds of jobs. There's a lot more part-time jobs than full-time jobs, and that's been a pretty clear shift. Again, you see managers keeping people employed, but keeping a lot of variability in how they are employed. And then a leading indicator of employment, one that makes a lot of sense, is temporary employment. Is it strong or is it weak? And that's down 10%. The level has fallen 10%. Again, that's pretty much recessionary. So that's the bad. I'll give you the good. Education and health, these two big sectors of our economy, and government to a degree, really steady as you go. Strong jobs growth. In 2023, I think we got 4% jobs growth in education and health. So really, really solid anchor underneath jobs growth. And then, of course, the amount of people who are out there, there's still some tightness in the labor market, a lot of backwash from immigration going down, legal immigration, and people moving around after COVID.
You know, it's particularly interesting when you're out at brunch with friends on a Saturday and the tech layoffs or any of the waves of layoffs that we've seen come forward, they make it to the conversation. And we're talking about economics at that point.
Yeah.
But we're also talking about whether or not that shows up in this print and acknowledging it's a mid-month to mid-month, perhaps in the next print that we get, do we start to see these layoffs show up in this?
Yeah, there's a lot of, this is all the busyness under the water, under the surface of the water. I'm glad you brought up tech and then bigger companies. These companies have been letting go. Yeah. They've been making the adjustment. It's the smaller kind of mom and pop employers who had a very, very difficult time in 21 and 22 hiring people. The big companies were able to hire people, no problem, really fast. And the smaller firms and companies weren't able to, so they're very reluctant to let people go. And if you have something like a GDP print, which again is a headline number, not really what's going on underneath, come in stronger, like it did just last week, the mom and pop companies are going to be saying, hey, let me try to hang on. I'll reduce your hours, maybe you'll go part-time, that kind of stuff as a way to keep things going. I think for the Fed, they actually want jobs growth down, maybe even, dare I say, negative, because they're trying to really nail it with this inflation that was a big mistake earlier.
Let's talk a little bit more about where we are in the inflation fight right now, getting back that final mile to that 2% level, what the Fed is targeting. We've been talking a lot about the disruption that's playing out right now in the Red Sea, a surge in cost there as a result of that, a shipping cost. What's the impact? Is there an impact, a real impact there on inflation? And what do you think that could do? And potentially, if it is, delaying the timeline of getting back to that 2% level?
Sure. So we're on a nice glide path down. We could get there, right? So let's just say that because there's inflation. But the key thing is inflation is cyclical. It goes down, but then it doesn't stay there. That's the weird part of the forecast. The expectation is it'll go down and just stick it and hang out there. What inflation does is it cycles up and down. Now you bring in supply chain issues. I think it's a very real concern of what we see going on in Red Sea. But then also, we're seeing other indicators of inflation around the world starting to perk up. Remember, we've had this huge downturn globally. And at some point that runs its course and starts bottoming out. It looks like on the price side that maybe what's in store for us in 2024 Supply chain issues are just adding on top of that. And the U.S. can't disconnect from that global inflation cycle. We're going to be part of it too. So I think it starts to limit the amount of leeway that the Fed has in 2024. And that is at odds with expectations, right? Expectations are, hey, we're kind of mission accomplished here.
Yeah, and we see a lot of that optimism priced into the market as well. Lakshman, always great to have you. Thanks so much for coming on set with us here today.
Thank you so much.
All right, let's take a look at some of the moves that we are seeing in crypto this morning, because Bitcoin trading under 42,000, just around that 42,000 level, about flat to where we were about a month ago. Prices recovering slightly from that steep sell-off that we saw following the approval spot Bitcoin ETFs. But now we could be seeing some momentum here because of a global push in terms of what we could be seeing approval-wise for funds. We want to bring Yahoo Finance's Jared Blickery for a little bit more on that. Jared.
That's right, Shauna. I had to check. Bitcoin is actually flat over the last month. You are correct. What I'm looking at here are all the Bitcoin and Ethereum and blockchain ETFs. A lot of these were just approved a couple weeks ago. That was a spot Bitcoin ETF push. And even within that group, we're seeing just a little bit of movement to the upside and to the downside. And then if BKCH, for instance, that is a blockchain strategy. So more than just blockchain in there. And some of these have Ethereum exposure. But overall, there's been a lot of enthusiasm over this. It looked to be, and we kind of saw this coming, a sell the news event, and that's Bitcoin topping out and then selling off after that announcement. But there's a lot of expectations about where the next jurisdiction is going to be. Australia probably in the leadership position there. To be fair, there's already a Bitcoin ETF in SIBO markets. That offering has been there for a while, but the main exchange is Australian Securities Exchange. That's the ASX, and there appear to be a couple of different Bitcoin ETF spot ones in the pipeline. And basically, this is just because other countries around the world don't want to be left behind in the future. You look back, how come you didn't have Bitcoin exposure? It's up 1,000,000%, or it's down 1,000,000%. No, you take a look around the world. Hong Kong is a potential jurisdiction. It's right by China. By the way, Bitcoin is still illegal in China, but Hong Kong is a major distribution center for finances. Singapore also mentioned, and then there's the UAE. The biggest problem with the UAE is there's just not a lot of interest there. But enough about that. Let's get to the underlying, the source here, and that would be Bitcoin itself. And we'll do some technical analysis, down 0.8% over the last 24 hours. And crypto broadly is seeing some down action. Dogecoin, by the way, up 2.5%. Haven't looked at that in a while. But here's the stair-step higher that we saw with the anticipation of Bitcoin. And this big launch here, that had to do with the spot Bitcoin ETF. And then this was the top that we were talking about. We came down to this support level. And let me change this to a 3-month chart so we can see a little bit better. Here is the support channel, the same one I was just looking at. Here is that downside breakout. It was a false breakdown. Bitcoin is famous for this. As long as Bitcoin holds 41,000, this is still a very bullish setup, not only on the short term, but intermediate term time frames. And on the longer term time frame, let's go to 5 years. You can see we're finally emerging out of this crypto winter that we have. And the timetables are changing. So across a multiple time frames, we're seeing the shift into bull mode. And a lot of this has to do not only with spot Bitcoin ETF and other regulations around the world, but just in general, regulators, especially in the US, the SEC and Gary Gensler, just kind of taking their boot off the neck of the crypto world and just letting it kind of come into its own. So lots of institutionalization to see in the years to come, and this is just a first step.
All right, Jared, thank you so much. Appreciate it. All your markets action ahead. Stay tuned, everyone. You're watching Yahoo Finance. The price of Bitcoin has no shortage of catalysts, from the debate around regulation to whether it's a security or a commodity, and whether or not it really is digital gold. But one event is undeniable in its impact on the world's most premier digital asset, the halving. Every 4 years, the reward for mining the biggest cryptocurrency is cut in half. This happens in order to reduce the amount of coins in circulation. How is it calculated? Well, it happens specifically every time 210,000 blocks are mined. We can calculate the date fairly precisely with the knowledge that the average block time for Bitcoin mining is around 10 minutes. That calculation gets us very close to 4 years. Why is it needed? because there's only so much Bitcoin available, 21 million to be exact. And like any other cryptocurrency, it needs to remain scarce to hold its value. So how often does this happen? Well, the halving takes place every 4 years. The first in 2012 decreased the award for creating a new block from 50 to 25 Bitcoin. The second halving in 2016, that lowered the reward further from 25 Bitcoin to 12.5 Bitcoin. Last time out, 2020. And you guessed it, we halved again. The block award dropping to 6.25 Bitcoin. So there's nothing wrong with your math here. This time around, the block reward miners will receive half, 3.125 Bitcoin. The big question, of course, what happens to the price? Now, the moves could be significant. In the past, we've seen Bitcoin rise after a halving event, though there's no certainty that this will always be the outcome. The other key focus is the outcome for the miners. The rewards that they're generating will, of course, diminish, and that's not great for an industry with a very high cost burden. Keep an eye on how the big publicly listed miners, the likes of Marathon and Riot, manage this event. As ever, talks of consolidation will no doubt do the rounds. No matter how you look at it, the event will have serious consequences for all crypto stakeholders and will be across all of the developments here at Yahoo Finance.
Over 20,000 tech workers have lost their jobs so far this year. That's according to the latest data out from layoffs.fyi. Now, the latest cuts coming from iRobot here today, just this morning, announcing that it's going to cut about 31% of its staff. And Glassdoor data showing a recent spike in layoffs is hurting employee confidence, that falling to its lowest level since 2016. So where does the labor market stand? We want to bring in Daniel Zhao. He's Glassdoor's chief economist. Daniel, it's great to have you back here in studio with us here. So ahead of the jobs report that we're going to get on Friday, the last several reports have really proven the fact, or really signaled that the labor market has stayed resilient, yet we keep getting these types of headlines, specifically within the tech sector, that they're losing jobs and they're continuing to lay off workers. What's going on? What's the reason for that?
Well, so I think it's interesting because we say that the job market has been resilient over the last year, and that's absolutely true, but it definitely has slowed. The hiring rate has come down pretty significantly, and then even though measured layoffs are still fairly low, clearly it is something that workers are concerned about. That's why we see employee confidence coming down, and that's why people are still concerned, even though the hard data is showing that the job market is still relatively stable.
And so for those who are now in the midst or caught up in these layoffs now, are there enough positions for them to get back into or to enter into elsewhere? And where is some of that rotation happening?
Well, I think that's a great question because the hiring rate has come down really significantly in the latest JOLTS data, and that's basically at its lowest pre-pandemic level since 2014. So hiring has really come down, even though layoffs haven't really increased as much as the headlines might imply. And I think that's actually creating a bit of a lock-in. You know, we talk about lock-in in the mortgage, or in the housing sector rather, but for the job market, we're seeing a lot less hiring, we're seeing a lot less voluntary turnover as people quit less, and there are a lot of people who are kind of hunkering down and in a bit of a holding pattern for their careers.
Daniel, we're getting headlines out. It seemed like that conversation died down about this push in the return to office, but Bank of America, one of the latest from Wall Street, really cracking down on the need that employees need to come back a certain number of days a week. What do you think that's going to do to the jobs market, to the jobs picture here in the next few months?
Well, I think it's really a signal of the fact that employers are getting more power, right? So over the last year or two, the balance of power has shifted back towards employers. That means that they can more aggressively pursue these return to office plans. And quite frankly, like it's still up in the air how exactly that's going to turn out, whether employees are really going to acquiesce to this or employers are going to have to push even harder.
And so as we're staring down this week's jobs report, what do you believe the data is going to tell us about the health of the labor market right now?
Well, I think the job market was resilient through much of 2023, and that is still probably the picture we're going to get in 2024. I don't think we're going to see really this latest wave of layoffs really affect the numbers very much, but I think that we are going to see some softening. We are going to see that the jobs growth slow down a little bit more, and also we're getting a lot of revisions in this report with benchmark update and that sort of thing, and I think overall it's going to show that 2023 was maybe a little bit cooler than we had originally thought.
Daniel, when you talk about so many of these headlines involving tech companies here, is that going to be the theme when you look out to the rest of 2024?
I guess it depends on what the theme for what, right?
The layoffs, yeah.
Yeah. For layoffs, I think we are still going to see a lot of tech companies try to cut costs and continue this year of efficiency mantra from 2023 into the new year. That being said, I think that a year is a long time. It's not really certain what exactly we're going to see in the new year. On the flip side, the industries that were hiring last year, I do expect to continue to add jobs in the new year. That's healthcare, education, government. Those sectors I do expect to continue to grow in the new year.
You know, we went from quiet cutting taking place and that being a talking point to now very loud cutting. And there's a larger question of what percentage of these jobs might actually be replaced by some type of generative AI? And are you seeing any listings now for either people being brought on to do those roles or it just being positions where they make the switch to say, okay, that is something that artificial intelligence can handle?
I think it's still a little bit early. Like a lot of these AI technologies are very new. They're not really proven. And so we are seeing some examples of companies investing and experimenting in these technologies. But I think a lot of companies are still hesitant to really pull the trigger and say, we are going to fully replace this job with AI. That being said, the advances in that space have been very, very rapid. And so I wouldn't be surprised to see disruption in this year. But I think it's not a foregone conclusion that we're going to see significant job displacement in this year. I think we're still in that experimentation phase.
Daniel, one trend that we are starting to see over the last several months, and it's likely going to just get even louder from here, and that's the fact that some of these workers, especially the younger ones who are laid off, they're making these social media videos here on TikTok, on Instagram that end up going viral. What do you think this just signals about the shift that we're starting to see within the workforce and how some of these companies are trying to mitigate some of the risk that could come from a viral video like that?
Well, I think it does show that the younger generations are very online, right? And that a lot of information can spread very quickly in today's world. And it's just kind of an extension of the fact that an employer's brand is very, it can be affected more in today's society, where information can spread quickly, where if you don't handle layoffs properly, if you don't treat your employees well, that's a risk factor for your employer brand moving forward. And not just in the short term, that's the kind of thing that people might remember for the long term if they know that your company handled layoffs poorly in the past.
Daniel, always great to get some of your insights. Thanks so much for joining us here in studio.
Thanks.
Daniel Zhao of Glassdoor, their chief economist, joining us here today. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
From iPhones and iPads to Macs, Apple Watches, and AirPods, Apple's products are a daily necessity for millions, and the numbers prove it. The company generated more than $394 billion in revenue in 2022 alone. But how were they able to achieve such staggering success? Beyond the Ticker charts its path to becoming a tech giant. Steve Jobs and Steve Wozniak founded Apple in Los Altos, California in 1976. That same year, Wozniak built the company's first product, the Apple I. Apple debuted the Macintosh with its now iconic 1984 commercial during Super Bowl XVIII. The Macintosh stood out because it was the first mass-market personal computer to feature a graphical user interface and mouse. Jobs left Apple after his famous falling out with CEO John Sculley in 1985 and subsequently founded the Next computer company. In 1991, Apple introduced the PowerBook line, which set the standard for most modern laptops. In 1996, after a run of CEOs, Jobs returned to Apple. The company purchased Next to use its operating system and named Jobs interim CEO in 1997. Apple introduced the iMac in '98, and the line would go on to sell millions of units. 3 years later, Apple debuted its first iPod, which could store roughly 1,000 songs. And that same year, the company opened its first Apple stores. But it was in 2007 that Apple unveiled its most important product of all, the iPhone. A revolutionary device, the iPhone helped create an entire business model around apps and the App Store. Jobs suffered from pancreatic cancer towards the end of his second term as CEO. He resigned from the company just before his death, and Tim Cook took over as CEO in 2011. In 2015, Apple took the wraps off of its first new device since Cook took over as head of Apple, the Apple Watch. Just 7 years later, Apple became the world's first publicly traded company to reach a market cap of $3 trillion. And in June 2023, the company unveiled its most ambitious product yet, the Vision Pro. A mixed reality headset, the Vision Pro is scheduled to launch in early 2024.
Warner Brothers Discovery taking a hit today. You're looking at losses of just about 2.5%. The move lower on a downgrade from Wells Fargo, warning of some risk ahead here before the company's earnings report. We want to bring in Alexandra Canal, who's closely following this call. And Ali, lots of questions going into this report here from Warner Brothers just about what the costs are going to look like and the expenses which continue to pile up.
Continue to pile up here. Like you said, the stock down about roughly 3% on that downgrade. Wells Fargo analyst Steve Keyhall downgrading shares from overweight to equal weight, citing those negative trends as we kick off the year. He slashed his price target to $12 from the prior $16 and also lowered his full year adjusted earnings estimates by about 5%, which is also 6% below Wall Street consensus expectations. And he cited several risks here as we head deeper into 2024. One of those being the fact that M&A, a lot of executive commentary as of late, seems to have thrown cold water on the idea. Also, the fact that we're entering an election year really doesn't necessarily mean that we'll see much of anything. There doesn't seem to be a big rush on the side of any of these big companies, Paramount included, to really make some sort of a deal here. Also, in terms of the content strategy, that's something else that Keyhall is looking at very closely, because management is really at a crossroads when it comes to balancing some of those original titles, maintaining that streaming exclusivity for Max, while also licensing content to competitors. He argues that there's a lot of opportunity there to potentially license some of those marquee titles like The Sopranos and Friends to a Netflix or even a Paramount. I think a lot of these companies would pay big bucks to have those types of shows on their platform, but at the same time, if they do that, that's going to hurt their engagement down the line. So even though the HBO slate looks pretty strong in 2024, there's these overhanging risks and really uncertainties about their 2024 growth initiatives that he's a bit concerned about.
Ali, while we have you, we also just got a report from Nielsen that Americans streamed a significant amount of TV last year. Just how significant?
Pretty significant, especially if you were a fan of Suits. Suits led the top 10.
I was shocked by that.
I tried to get into it, and I just couldn't get into it.
I couldn't get into it. I need to give it another
cheesy.
shot, though.
I think I need to, too, but that led the top 10 most streamed titles for 2023. This is a show that debuted years ago. 57.7 billion minutes viewed. That's according to Nielsen. And it gets back to my earlier point of just about content licensing. I mean, Netflix licensed this content. It wasn't a Netflix original title, yet it was at the top of this list. The highest original title was actually Ted Lasso from Apple TV+. I like Ted Lasso, but you think about Apple TV, it's a much smaller competitor. It definitely is more niche programming, but people really connected to that show. But interesting to see Suits leading #1 show of the year.
And Bluey and Cocomelon, two shows that have been played very often in our household here over the last year. They close in second and fifth spots. This is a surprising list, I gotta say. I wasn't expecting those two.
Like, what is it?
I'm sure that piqued the interest of those that maybe wouldn't have previously been into it.
All right.
Who knows?
Ali Canal, thank you so much. Appreciate it. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
From its subscription concept to the rise of streaming, Netflix has built itself into a force in the entertainment industry. The company generated over $32 billion in revenue in 2023, including over 247 million subscribers worldwide. Beyond the Ticker takes a deep dive into the company's biggest moments. In 1997, Mark Randolph and Reed Hastings founded Netflix in Scotts Valley, California. 3 years later, Netflix launched its monthly subscription concept. DVD rentals were mailed to customers, along with prepaid return envelopes. Later that year, Netflix was almost sold to Blockbuster for $50 million, but Blockbuster declined the offer. In 2002, Netflix launched its IPO, selling 5.5 million shares at $15 each. It brought in $82.5 million. 5 years later, Netflix announced that it would debut streaming video while retaining its DVD rental service. Netflix stock fell to around $9 per share in November 2011 after the company revealed that it lost 800,000 subscribers in its third quarter. 2 years later, Netflix released House of Cards, the beginning of Netflix's original programming. In 2015, Netflix shares surged to an all-time high, over $100 per share. That was growth of 574% over the prior 5 years. In 2017, a study by PwC showed that the Netflix subscriber base was now equal to the number of cable TV subscribers, 73% of all U.S. households. 4 years later, Netflix launched its gaming platform Netflix Games, available on Android with 5 games at launch. The company also announced plans to expand its gaming service to iOS. In 2023, Netflix announced the wind down of DVD.com with its last shipment on September 29th.
Well, 2023 was the hottest year on record by far, and scientists say that we will continue to see record-breaking years as the planet warms if we don't get CO2 emissions down to zero. One industry with a surprisingly high percentage of emissions, buildings and construction. It is responsible for 38% of worldwide emissions, with concrete alone accounting for 8% of global emissions. Our next guest runs a company that is looking to bring that number down to zero. They have developed the world's first building material that avoids emissions and removes carbon from the atmosphere. Joining us now, NBA superstar turned actor turned climate tech CEO. We've got Rick Fox Partana, founder and CEO, with us here in studio. Great to have you here.
Thank you, Brad.
Absolutely.
Pleasure to be here.
I mean, you've had a busy, jam-packed schedule to start off this year. You were just at the World Economic Forum in Davos as well. Yeah. You know, when you think about how much work still needs to be done and whether or not world leaders are heeding that charge and that need to make a severe change, and where your company comes into play there, you know, what was the tone, the tenor that you kind of sensed from the discussions?
It was my first Davos, but I have to say that I was engaged and in charge with the excitement around new positive building materials to add to the construction industry space, choices that are more nature positive. We discussed, we debated where we go in the world here now today around this area and this challenge around heat and climate change. And we discussed CCUS, we discussed Partana as a solution to carbon absorption and removal. And so we're one of the players, one of the solutions in the future here that can add to changing the way we build in the world for good.
When you talk about the material and the difference for Partana and what you're bringing to the market, naturally, a lot of the attention will go towards, okay, well, what's this going to cost us? How much different is the cost between the existing concrete that people have become accustomed to that creates an emissions problem versus what Partana is bringing to the market?
So I will give you comfort in the area of we currently have customers. So those out there that want to make the change from the traditional materials that are being used to more nature-positive materials, they're making decisions around purchasing our materials, which is great. Depending on the product, there's a large scale and spectrum from high-end products all the way down to affordable housing. So where we are in the Bahamas right now, under the leadership of the Prime Minister of the Bahamas and the government of the Bahamas, we're building affordable housing, some 1,000 homes there, where the materials there, obviously the margins are lower in that regard, all the way up to higher end developers where we're building materials and structures for high-end development, luxury developments. So you'll get the wide range. The price in general, depending on where you are in the world, determines where you're getting your materials from. Concrete in general, cement as a binder in general, has fluctuated as a commodity for many years, many decades. Ours will be no different. When you think of the price, just think of us as a simple plug and play. For cement, we take the binder of cement out of the production of concrete and we plug Partana in. So no extra equipment is needed. All the aggregates and materials that would make concrete with regular cement, you use our Partana as a solution.
And then scaling, what does that look like for the business as you think about the roadmap for this point going forward?
Well, the two challenges, and I think our business model, are scaling because it requires CapEx, and then also change, getting people to adapt to a new way of being, right? As you can imagine, CapEx and building factories is not the easiest thing for an investor out there in your audience to get excited about. But as you can see from CCUS, billions are being poured into that execution. Now, we avoid and remove CO2 in the process of making our concrete without the use of extensive energy. We cure at room temperature. So you take our materials and through the magic of chemistry, you get to a concrete without the negativity that's produced from energy in the area of CCUS. At the end of the day, Rick Fox is not the scientist in the room, so we can all relax. My history being from the physical arts and sports and also in the entertainment arts is now pushing me to be an innovator in the area of team building and the area of bringing the brightest minds in the world. And when I point about the science around our Partana, we have some of the greatest scientists in the world that worked on this for 6 years. They've been innovating concrete for decades. This happens to be their greatest contribution to the world right now, bringing this material to the world. Excited that their work will be seen from the lab to actual commercialization, which is usually the biggest challenge. We talk about the financing of something like that, the scaling of something like that, and then also the challenges around getting people to adopt something like that. I would challenge people and comfort people with the news that when you are verified stringently, globally, by the verifying bodies, ASTMs, interlockings, any international standard, I promise you that we would not be allowed to build structurally anywhere in the world if it wasn't approved by the architects and the engineers and the technical folks that make sure that when a person walks into a building, it is safe for them to be in. We've passed all of those standards. We now are moving to commercialization, and we're finding the partners that want to innovate in the world, that want to make these changes and bring these materials to bear.
You have had a storied and perhaps one of the most interesting men type of lives. When we think about, I thought you'd be the next Dos Equis man at some point, just the most interesting man in the world, with the different kind of avenues that you've had, professional sports, acting, and then you think now as climate tech investor, CEO, when you think about, and I'd be remiss if I didn't ask you a sports question here, but when you think about some of the deals that are coming forward right now and the new way that sports are being consumed, how does that set up for the next fan that's out there that's engaging with sports, engaging with athletes, and how has that kind of materially changed even since the time that you were at the peak of your career too?
Yeah, I was blessed to grow up in an era in the NBA where athletes were moving towards a life after basketball is something on the forefronts of their minds. You look at the Magic Johnsons, you look at today's athletes in LeBron James, individuals that understand their impact, understand that their skills on the floor can also translate off the floor, right? I've just simply taken what I've learned under some of the greatest coaches in the world, Phil Jackson, Dean Smith. I've taken what they taught me about teamwork and the building of a successful journey towards a championship output, and I've incorporated it and layered it into my business life. Why am I the leader of Partana? Simply put, as a founder, I'm answering and solving an innovative question that has to come to the world. I have to thank the Prime Minister of the Bahamas, who took the courage and took an innovative step to invite us to come to the Bahamas and work from the front line of climate change, right? And so it takes the courage that you would say to get up every day, play the game of climate technology now instead of basketball, take the wins and the losses and completely search out on a daily basis those teammates that can join that journey, that care about the mission of changing the way we build in the world as a more important mission than their own individual goals. And that's what we have today. We have a team at Partana that mirrors one of the greatest teams I've ever been on. Yeah. And I know we talked about your Sixers, and I'm a dear Larry. I'm a dear Larry Brown fan and an Allen Iverson fan. But the success we had there under the likes of the Shaq and the Kobe, great talented individuals, are no different than this team at Partana with great talented scientists, me leading that just to make sure that their innovation gets out into the world. And if it starts in the Bahamas, a little small island, under the leadership of Prime Minister Davis, and it ends up in the world, that's where it's supposed to be. It's supposed to get out into the world.
Rick, great to have you here in studio with us. Thanks so much for taking the time. Rick Fox joining us here on Yahoo Finance, everyone. Shauna, I'll toss things on over to you.
All right, Brad, let's take one more look here at big tech, because it is certainly going to be a huge week for the market. And like you can see, it's mixed overall for the major averages, and it's also mixed for some of these tech leaders. We're going to be hearing from Microsoft, Amazon, Apple, Google, Meta. Market value of more than $10 trillion. So certainly you want to keep these names on your radar this week. That's all for us. Akiko and Rochelle have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akutho alongside Akiko Fujita. Here's what we're watching this morning. Looking at shares of Hong Kong-listed Evergrande closing down more than 20%. That's after the stock was halted. The Chinese property developer received a liquidation order from a Hong Kong court. How this could impact your portfolio coming up this hour.
And Flutter Entertainment looking to capitalize on the growing sports betting space, making its U.S. debut. We're going to speak with the CEO on the floor of the New York Stock Exchange up ahead.
That's right. Plus, of course, a big week for tech. What investors should expect as more Mag 7 giants get set to report results.
But first, let's take a look at where the markets are trading 90 minutes into the trading week. A bit of a flat trading day, you could argue, kind of in a holding pattern right now with the Dow down 33 points, the S&P 500 trading flat, and the Nasdaq up 12. As Rochelle said, investors gearing up for a very busy earnings week. 19% of the S&P 500 reporting this week, with the big tech companies certainly going to be in focus there. Also, the Fed meeting, Fed starting its two-day meeting tomorrow, and we are taking a look at Treasury yields on the back of that as investors await that Fed decision come Wednesday. Take a look at where things are, all pulling back from the longer end to the shorter end here. The 5-year yield at 4%, the 30-year yield at 4.35, and the benchmark 10-year at 4.11. We are beginning this hour, though, with a developing story in Asia. A Hong Kong court ordering one of China's largest real estate developers, Evergrande, to liquidate. That sent its stock plunging in Hong Kong trade before shares were halted. The court will now appoint a liquidator for Evergrande's parent company, who will sell the company's assets to repay its debt, which hit a whopping $300 billion. The move is just the latest in a deepening crisis in China's property sector, which makes up roughly 25% of the world's second largest economy. And Rochelle, of course, the immediate question here is whether, in fact, a mainland Chinese court will accept the ruling that came through from the Hong Kong courts, because they are separate systems. A majority of Evergrande's assets being held in mainland China. We're talking about this, of course, in U.S. trade, though, because there are concerns about the ripple effects this could have beyond China. And, of course, a huge, huge impact within the Chinese market here, the second largest economy in the world. In many ways, Evergrande's kind of become the poster child of a deepening crisis in the property sector there. The question is this a one-off of a company that was kind of considered the bad boy in real estate in China, or is this a sign of things to come? And could that potentially trigger a financial crisis?
And that's what people are really worried about. They're worried about the contagion aspect of it, because on the one hand, a lot of people thought Evergrande, much like Country Garden, was just too big to fail. So they're waiting for this rescue to come from Chinese policymakers, at least for now, at least based on the Hong Kong court decision. Not seeing that. We know that President Xi wanted to pull back on a lot of the speculative buying that led to the ballooning of a lot of this debt for some of these real estate developers. So it's interesting because you're balancing not coming in to rescue, at least for now, Evergrande, with also some of these other policies that are supposed to be uplifting the economy at a time where it's slowing faster than expected, Akiko.
Yeah, and for those who haven't necessarily been following this story, we should mention some of this was telegraphed. Evergrande defaulted on its debt at the end of 2021. They filed for bankruptcy last year. And then, of course, the head of Evergrande, the founder, was placed under police surveillance, which is something that we have seen in China when the government really tries to crack down what they consider to be more bad actors in the sector. So you mentioned Country Garden. They were sort of seen as more the responsible players. There were real concerns when they defaulted on their debt as well. So obviously the property sector is something that's certainly going to stay in focus. But of course, any kind of contagion effect coming out of the world's second largest economy going to have an impact here in the U.S. as well.
Indeed, and we'll continue to track that, of course. And also tracking oil prices today. They're lower as the conflict in the Middle East escalates. 3 U.S. soldiers were killed and dozens wounded by a drone strike by Iran-backed militants on Sunday. Iran denying that, though. But President Biden vows to retaliate, saying in a statement that those responsible will be held to account. As for Iran, the nation's foreign minister is distancing himself from the attacks, saying that accusations of Iranian involvement are, quote, baseless. With tensions flaring, what can we expect the fallout to be for the oil market? Joining us now, we have Scott Bauer, Prosper Trading Academy CEO, and Aham Kamel, Eurasia Group Middle East Practice Head. So, Aham, I want to have you first set the scene here in terms of what this means in terms of oil supply and demand, now that we see that this is escalating.
I think in the first instance there'll be no direct impact on oil supply in the region. I think more likely than not, the Biden administration is creating a calibrated military response that appears very loud in terms of targeting militias in Iraq and Syria to rebuild that lost U.S. deterrence on the military front. But I think the appetite to move into something direct that hits Iran or hits Iranian export, it's still low for now. So I think there's reluctance to do something in terms of tinkering with the oil supplies that might impact inflation expectations and over the long term, even Biden's own position domestically. So more likely than not, we're looking at a contained sort of conflict with a higher risk that it expands. For now, the Biden administration is probably going to be careful.
Scott, let me get your reaction to what Aham said. I mean, do you agree that potential disruption to oil markets pretty much contained there, and that the broader concern as it relates to the energy space really is about the demand picture, largely coming out of China, too?
No doubt about it. And I wholeheartedly agree. I do think even now with oil prices down today, there's probably about $3 to $4 of risk premium already built in because of tensions in the Middle East, especially with what happened over the weekend. But you can see the reaction today. It really goes to what you guys were just talking about, that the response is probably going to be very tempered. And the bottom line is oil prices are on their heels right now. And it is all because of demand or lack of it, should we say. We do have OPEC coming out next week, which, given everything that's going on, given the tensions in the Middle East, that could disrupt the marketplace. But I really don't think so. So to me, as a trader, I actually love this extra volatility. And though much of the marketplace is looking at this as a buy the dip because of the escalated tensions out there, I actually look at this as selling, what we call selling the rip, or selling a move higher, because the overall macro picture of crude is absolutely on the bearish side. Obviously, things can escalate very quickly. You can always have a big pop if, God forbid, something really tragic happens here. So if you're trading it with options or just with futures, you always need to use a stop. But I would look to sell any pop that we get in the near term.
So in terms of the response that we tend to see from OPEC, as we saw with the Russia-Ukraine crisis in the middle here, what sort of response are you expecting from OPEC at the upcoming meeting?
Well, I think Saudi Arabia, who really exactly is the engine of OPEC Plus, will be looking at a very comfortable price range. I think for the Saudis, OPEC Plus in general, any range of oil prices in sort of the 80s is completely acceptable. There's not likely to be a big reaction to put additional barrels on the market in the current environment. One exception to that would be if we saw an escalation of the regional conflict and it begins to impact supplies. Then the Saudis would consider to work more actively with OPEC Plus to try to create some form of relief over there. But currently, given just the demand picture that we've discussed on the show and sort of the supply risks as they are, the Saudis will be cautious in terms of putting additional or taking barrels or putting additional barrels on the market. Stable status quo works for now, particularly given the spending commitments on Vision 2030. And I think that the Saudis can deliver on that. One key point I would just add that yes, there is sort of an intention by the Biden administration to calibrate its response, but military conflicts and regional crises have the tendency to create their own dynamics. Where we are today is not a very comfortable place in terms of risks in general. I do expect additional tit-for-tat sort of military strikes and confrontation between the U.S. and the militias in Iraq and Syria. This is not going to be a comfortable couple of weeks at all.
Scott, let's pick up on that point, because since October 7th, when this conflict began between Israel and Hamas, so much of that risk concern in the Middle East has been about a direct conflict between the U.S. and Iran. It feels like with every strike, you're getting closer to that. Now you've got 3 Americans that have been killed as a result. Within the context of the energy markets, What would be that trigger, you think, that would really lead you to be concerned about disruption in supply when we're talking about sort of looking at the conflict that's playing out in the context of oil?
Sure, and any further escalation of what we saw over the weekend. So direct hits, direct strikes on American interests, on American soldiers. That is where the escalation would be. And this weekend, the tragic events that happened, that certainly is one of those scenarios. As you guys just discussed, I would expect, I agree, some tit for tat. Until that really escalated, though, I don't think it's going to affect the crude, the oil markets, but that's always a possibility. That's always something that's out there. And that's why I said earlier, I really believe there's $3 to $4 of extra premium built into the price of crude right now. We all hope it doesn't happen, right? We all hope that the supply doesn't get affected because of an escalation. It certainly is a possibility. It is not a probability. It is a possibility. As you just said, it's going to be a volatile next couple of weeks here. I would not expect Saudi to do anything at the OPEC meeting. I think the market is already pricing in that they're not going to change their stance, whether it's more supply or even pulling more off of the marketplace. So I think it's still, fairly status quo. And given any big heightened escalation, I think you really have to look for crude to move lower. It's just that it's all about the demand right now, unless there's a big escalation.
So, Scott, a $3 to $4 risk premium already baked into oil prices. In the meantime, though, if you're looking medium term, what are we talking about? Mid 70s, low 70s?
Yeah, I think we could hit 70 to 72 area if the conflict remains where it's at right now. Within the next couple of weeks, I would not be surprised to see that 70, 72. If there's a breakout on the upside above the 81 area, that's where you could see short covering coming in and you could see a big precipitous pop. But I think that 70, 72 area, if the escalation does not happen, that's where we're going.
Well, I appreciate both of you for joining us with your insights in this important context as well. Scott Bauer and Aham Kamel, thank you so much.
Thank you.
All right, time now for today's trending ticker. We're watching the big tech stocks. Amazon, Alphabet, Meta, Microsoft, and Apple all set to report results this week. Akiko, I'm zoning in on Amazon, so they're reporting on Thursday. I think it'll give us a really good look at a mix of things. You have the consumer demand that we're seeing, especially after Amazon touted its record-breaking holiday sales. Of course, you have streaming, you have sports, you have cloud in relation to AI as well that I'll be looking at. And of course, the new rollout of its ad-supported tier that MoffettNathanson's lead analyst Michael Morton called the 500-pound gorilla entering the room. And he's looking at its active user subscriber base on par with Netflix. So really seeing some upside for this year and next year as well, Akiko.
Yeah, of course, AWS, the big driver for Amazon always. That's a number we're going to be watching closely. But some interesting headlines today, Rochelle, coming ahead of those results with that acquisition of iRobot really coming to a halt here, essentially not going through because of regulatory concerns on that front. So some headlines there as well. As you pointed out with Amazon, it's always interesting to get the consumer pulse as well, at least on the e-commerce side. So we'll be watching that one closely. I'm watching Microsoft really closely for very obvious reasons. When you think about the big tech rally that we have seen, it has come on the back of this optimism around AI. And you could argue Microsoft a big driver of that, hitting that $3 trillion market cap. Of course, when you think about where Microsoft is in its AI rollout, you've got that Copilot key already integrated into PCs that are coming out as well. Microsoft has said that's just the beginning in terms of the user experience. So we'll be looking for some hints on what additional measures that are likely and what additional features that Microsoft is hinting at. And of course, the bottom line here, investors are going to be asking, well, what does that revenue look like that's coming in from AI? So certainly a lot going across the board, but just given the run up that we have seen in Microsoft, as well as other mega cap stocks, certainly going to be a consequential week here with all those big tech companies results reporting this week.
I mean, and when you look at where valuations are, and then you look at where Microsoft is now, I mean, a year from now, we wouldn't have thought that generative AI would have really pushed it past Apple, where we think of, when we think of market cap and the potential for it to overtake it. But when I think of Apple, you think it has that nice, secure moat. But then we saw that slowdown in demand. We saw people not buying as many devices. And as we've been talking about, we have that upgrade cycle that's also coming up, which could also be an additional boon for Microsoft as well. So interesting positioning here. There'll definitely be an earnings call I'll be excited to listen in on.
Yeah, I mean, you mentioned Apple reporting later this week. I mean, there's still questions about what the Gen AI play is for Apple, right? I mean, they are obviously working on that in-house, but we'll be looking for some additional hints on that front as well. Well, coming up, we'll head to the floor of the New York Stock Exchange for an interview with the CEO of Flutter after its U.S. debut. That is coming up on the other side of the break. We'll be right back.
Welcome back to Yahoo Finance Live. We are here on the floor of the New York Stock Exchange, and standing with me is Flutter Entertainment CEO Peter Jackson. Flutter committed a dual listing today on the New York Stock Exchange. They are planning to have a primary listing on the stock exchange later this year. Flutter, of course, the parent company of U.S. sportsbook FanDuel, the biggest U.S. sportsbook in the U.S. Peter, obviously a big moment for you here. A lot of people have been anticipating this. I guess why now? Why come to market now?
We've been really excited to come and list our business here on the New York Stock Exchange. It's the world's biggest capital market. We're the world's biggest sports betting and gaming business, and we thought it was the right thing to do. It's taken us a bit of time to go through all the work to get our secondary listing accepted, but we're delighted we're here and we're very excited.
And you mentioned the overall size, and that's one thing that's a big topic in this industry is sort of the growth of sports betting that we've seen in the U.S. since it was legalized and potential further growth. You have projections for there to maybe be a total addressable market of $40 billion by 2030. How do we get there?
We are a fast-growing business. If you look at our revenue growth last year, we're up 25%, and we get the benefit here with Flutter of owning FanDuel, but also all of our international businesses, which are growing between 5 and 10% as well. The $40 billion figure that you referenced, we simply looked at the number of states that we anticipate licensing, look at the penetration rates that we expect to get to in comparison with sort of Australia and other markets, and we look at the sort of the average bet size that Americans are doing, and that's where we get to the 40 billion. I suspect it'll turn out to be conservative because everything in America turns out bigger than you expect. So.
How big of a concern is legalization? We know that hasn't necessarily been a linear path thus far. I'm thinking of California in 2022 not approving legal sports gambling like many of the other large states have. Is it a concern that maybe the market never gets to all 50 states and gets as big as it could be?
There are clearly going to be some states which should be holdouts, right? So we don't expect Utah to pass legislation. When we look at the three big states between Florida, Texas, and California, we'd expect that we'll be operational in at least one or two of those states in time. Look, there's plenty for us to go after. We're in 45% of the population here in the US can already avail of the FanDuel sportsbook, and there are more states that we think will come on stream in time.
And I'm curious, Peter, when you think about competition in the space, one of the big discussions entering this football season here in the fall was ESPN getting into betting for the first time, right? And we had Fanatics getting into betting. So some new players after you sort of work so hard to dominate the market share with DraftKings. How's that impacting your business right now and maybe the marketing spend that you have to put out?
Every year at the beginning of the football season, we always talk about the fact it's going to be competitive, and it always ends up being. Every year there's been someone coming in trying to make a splash. The thing that we're really focused on is making sure we deliver the best product for our customers. And that's what sets us apart. The same game parlay that people love and are really embracing in American football and also in basketball, something that we pioneered and we're well ahead of the competitors. And that's what's really important for us in this market.
Same game parlay is going into one game and betting on multiple outcomes, right? Betting on someone to score a touchdown and maybe betting on their team to win and combining those bets into one. Absolutely. How has that helped you as a business? Because I'd imagine that might be a higher margin part of the business.
Look, it's a very complicated thing to pull off, right? And kudos to our team in Australia who solved the math involved in those outcomes because they're all related with each other. But from a customer perspective, it's something which is so exciting when you're watching a game and you've got a view that someone's going to reach those rushing yards targets or score a touchdown or your team's going to win. You can combine them all together. It keeps you focused on the game right up until the end. And that's why we think customers have been so engaged with it. And in Q4, sports results went against us. We gave $343 million to our customers, because the sports results went against us. So these parlays work sometimes for us and sometimes for the customers.
How do you manage that as a business when you have that much money going against you?
We're a well-diversified group, and that's one of the things that really helps us. We're the world's biggest sports betting and gaming business, #1 here in the States, we're #1 in the UK, #1 in Australia, very strong positions in many other markets around the world. And that diversification of geography and sport really helps us.
And Peter, it is the day after the NFC and AFC championship games, so I have to ask you about the Super Bowl coming up in 2 weeks. We have Chiefs and we have 49ers. I'm curious, just for you as a business, is this still kind of the biggest weekend for the sports betting industry in the U.S., or is that starting to shift as the market matures?
It's interesting. If I look at the amount of bets that we had on those two games, yesterday, if I just take the 49ers game, that was the single biggest game we've had since the Super Bowl last year. So we're sure the Super Bowl will break records for us in a couple of weeks' time. It's always fascinating to see where the weight of the money ends up on the different teams. Yesterday when we looked at the weight of money, the 49ers were not that strongly backed. It was interesting to see them come through. Look, we'll be rooting for our customers and try and deliver them a brilliant experience in the Super Bowl.
Is that your way of saying you don't have a pick for us?
I'm not going to give you a pick. I don't want to get caught out doing that. But look, we'll be very excited. There'll be 600 markets available for our customers to select from. The big question, though, for the Super Bowl is, will the Gronk make it or will he miss? That's what we don't know this year, and you have to watch the Super Bowl to find out.
We'll be watching for that FanDuel ad during the Super Bowl with Gronk. Peter Jackson, the Flutter Entertainment CEO, We will be back with more Yahoo Finance Live on the other side of this break.
From iPhones and iPads to Macs, Apple Watches, and AirPods, Apple's products are a daily necessity for millions, and the numbers prove it. The company generated more than $394 billion in revenue in 2022 alone. But how were they able to achieve such staggering success? Beyond the Ticker charts its path to becoming a tech giant. Steve Jobs and Steve Wozniak founded Apple in Los Altos, California in 1976. That same year, Wozniak built the company's first product, the Apple I. Apple debuted the Macintosh with its now iconic 1984 commercial during Super Bowl XVIII. The Macintosh stood out because it was the first mass-market personal computer to feature a graphical user interface and mouse. Jobs left Apple after his famous falling out with CEO John Sculley in 1985 and subsequently founded the Next computer company. In 1991, Apple introduced the PowerBook line, which set the standard for most modern laptops. In 1996, after a run of CEOs, Jobs returned to Apple. The company purchased Next to use its operating system and named Jobs interim CEO in 1997. Apple introduced the iMac in '98, and the line would go on to sell millions of units. 3 years later, Apple debuted its first iPod, which could store roughly 1,000 songs. And that same year, the company opened its first Apple stores. But it was in 2007 that Apple unveiled its most important product of all, the iPhone. A revolutionary device, the iPhone helped create an entire business model around apps and the App Store. Jobs suffered from pancreatic cancer towards the end of his second term as CEO. He resigned from the company just before his death, and Tim Cook took over as CEO in 2011. In 2015, Apple took the wraps off of its first new device since Cook took over as head of Apple, the Apple Watch. Just 7 years later, Apple became the world's first publicly traded company to reach a market cap of $3 trillion. And in June 2023, the company unveiled its most ambitious product yet, the Vision Pro. A mixed reality headset, the Vision Pro is scheduled to launch in early 2024.
Well, stocks a bit muted this morning as investors brace for a big week ahead, including January jobs numbers and the latest policy decision from the Fed. Let's bring in Marvin Lowe, State Street Senior Global Macro Strategist. Marvin, good to talk to you this morning. Taking a look at where Treasury yields are tracking today, we're seeing a bit of a pullback broadly from the longer to the shorter end. As you look ahead to Decision Day Wednesday, how are you positioning your portfolio?
Yeah, I mean, it's really a function of whether or not we're going to get anything significant coming out of the Fed. We have been increasingly in a range-bound environment, if you will, somewhere between 4 and 4.25. As we get closer, it gets kind of narrow in there. I think I'm positioning basically around the fact that we're going to stay in that range, and that commentary that the Fed is going to, be cutting at some point in the next several months remains in place.
And of course, a lot of people wondering when we're going to see that first rate cut. And obviously, depending on the circumstances as to why the Fed would also need to cut as well, despite getting some political pressure, as we saw earlier today from Elizabeth Warren. What is your take on what makes sense in terms of the first rate cut? What sort of circumstances?
Yeah, I mean, so far it does look like the economy is holding in. Certainly, we've got better inflation data that makes the argument that the Fed should be cutting earlier. But at the same time, we've got consumer strength, we've got employment strength. And what we saw in last week's growth numbers, the GDP numbers, it shows that there's that momentum that's carrying itself into the beginning of this year. To me, I'd like to see how all these chips fall so that we can assure ourselves that inflation is in fact moving in the right direction and will remain in that correct sweet spot, if you will. And that's a May-June time period for me, probably leaning a little bit more into the middle of the year than over the next 2 to 3 meetings.
We mentioned the Fed meeting as well as jobs report. We've also got a slew of earnings coming down this week from those mega cap tech names. Given the run-up that we have seen in these names, is there a situation where you would see yourself adding exposure depending on what comes down in earnings, just when you think about just how high the valuations are right now?
Yeah, I mean, that's the biggest challenge, certainly. The valuations make it hard to add. Kind of having said that, I do think you wind up in an environment where if you're maybe more tactical in trading and you can ultimately move around and trade around some of the volatility that might come around, I think it still is supportive for overall risk because we're, again, going to be in an environment where we think the next move from the Fed is going to be a cut, and we can ultimately start seeing it within a very short period of time. But you're right, valuations certainly make it hard. The breadth of this rally that we've seen over the last couple of months has focused on those real mega caps, and we're going to get a sense this week as to whether or not it's justified.
Marvin, of course, investors with that one eye on earnings and really begging for some clarity from the Fed as well. But one thing, we talk about that headline inflation number, but what about the balance sheets, things rolling off the balance sheets? Do you think markets are perhaps underestimating and not paying enough attention to that?
Yeah, 100% that they're not paying attention to it. I do think that there's a easy way of looking at the balance sheet, and that's the way the market's taking it. Once the Fed starts to cut, they're going to stop the shrinkage of the balance sheet, QT, if you will. I don't necessarily think that's a given. And I think the market potentially could be surprised that the Fed continues to shrink the balance sheet even as they start cutting rates, because bottom line is the balance sheet's too big. Based on how they generally approach bank reserves, those bank reserves are still much too large within the system. And that might not package as well as what the market expects. So it's a buy the rumor, sell the fact kind of situation that I see, particularly with regard to the balance sheet.
Well, hopefully more investors now keeping that on their radar. Appreciate you taking the time to join us this morning.
You.
Marvin Lowe, State Street Senior Global Macro Strategist. Thanks so much. All right, we have all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
Pumpkin spice latte season is over, but investors are eager to see what kind of a boost the seasonal treat will give Starbucks in its next earnings report. Last time out, the Green Siren handily beat Wall Street's expectations. The business's domestic performance was the big winner in its fiscal fourth quarter. U.S. and North America same-store sales rising 8%. But the bar keeps getting higher for CEO Lakshman Narasimhan. still in the early innings of his leadership, and a high-profile reinvention strategy. Here are the 3 key areas you'll want to keep an eye on when Q1 numbers hit. Number 1, innovation. The recession that was definitely going to happen did not, but the risks of consumer belt-tightening never disappear. Record sales in the fiscal fourth quarter were no doubt padded by the early appearance of the most popular seasonal drink on the menu. As such, innovation is key. Can the pistachio latte and fresh food offerings help drive same-store sales growth? Snacks are another big area. Also, is anyone ordering tea? Number 2, China. The coffee giant's second biggest market is a big earner and needs to perform. 2023's watershed year is just the beginning. It's a largely idiosyncratic story. How much will depend on the government plans to juice the consumer? Starbucks' plans in the nation are not modest. It aims to grow to 9,000 stores in the country by the end of 2025. That's against an even more ambitious goal to expand its total store footprint to 55,000 stores by 2030. Number 3, costs. The strategy to slash costs by $3 billion in 3 years is no small goal. A key pillar of the triple shot reinvention strategy, it will look to efficiency savings in a bid to boost margins and shareholder returns. The perfect blend here, $1 billion to store efficiency and $2 billion on the cost of goods sold. Amid all this, we're looking for any update on the union drive. If Red Cup Day taught us anything, it's that this is an issue the company will need to address sooner rather than later. For all this and more, don't miss Yahoo Finance's coverage on Starbucks' first quarter earnings report.
The gig economy is on the up and up. More than a third of workers performing freelance work in 2023. That's according to an Upwork report. And gig workers contributed more than $1.2 trillion to the U.S. economy last year. Rochelle, I guess the key here is that they performed freelance work. So it doesn't mean they were freelancing full time. But the number that stood out to me in this report, 23% of all freelancers, 14.7 million professionals created influencer content like live stream services, social media videos. So the question I have is it just that there's more platforms out there that allow you to freelance, or is it about flexibility?
I mean, you figure it's got to be about a bit of both, and also trying to keep up with the cost of living as well. Because as you mentioned, it might not be that these people are doing freelance work as their permanent gigs. It could be like a little bit of something on the side to perhaps like supplement their salaries. I thought it was interesting that they contributed $1.27 trillion in annual earnings. And so it makes you wonder, though, how much of this is being reflected in the jobs numbers. I mean, I think during COVID, it was easier to hide if you had a second or third job when you were working remotely and nobody knew. But as people are returning to the office, it's getting a little bit more difficult to balance these things. But I thought it was interesting that you're also seeing a lot of these well-paying jobs they're not the traditional ones that we all thought of growing up. You mentioned the influencer economy. Even on Indeed.com's top jobs, their top job that they have on there that doesn't require a degree, a loan officer, $192,000. So these are things, and most of the phrasing was either hybrid or remote. So there is a lot more flexibility now, and I mean, good. People are taking advantage of it to cover their costs.
It's time to find a side hustle.
We'll see. I have to figure out what I'm good at. Other than this, of course. Well, of course, we know the gig economy is growing, but is the government doing enough to protect those workers and enforce the rules? Now, gig workers often don't get paid at the same level as full-time employees, and they don't often get benefits such as healthcare. Now, earlier this month, the Biden administration issued a rule compelling companies to treat some workers as employees rather than independent contractors, saying businesses must extend benefits and protections offered to employees to other workers that can fit certain criteria. For more on this, Terry Gerstein, NYU Wagner Labor Initiative Director, is here. So I want to talk about your op-ed here, because this idea of how people are being classified. For some people, they do want that flexibility of remaining a gig worker, but then you see these rules coming down the pipeline, really narrowing that definition. What are the biggest benefits for some of these gig workers from these rules?
So first of all, thank you for having me today. And just to be clear, our workplace laws cover employees and protect employees, not independent contractors. And the idea is that independent contractors are running their own totally independent businesses. And so that includes minimum wage laws, overtime, the right to be paid for all hours worked, also safety nets like unemployment insurance if you lose your job, or workers' comp if you get injured, the right to form a union or have a safe workplace. So all of these laws protect employees and not independent contractors. And that is why this new rule from the Biden administration is so important, because a lot of corporations have kind of taken advantage of using a model and calling people independent contractors, sort of engaging in the fiction that they're running a totally independent business, when in fact they are employees. They're working under a lot of control by the business. They're doing work that is, not really running their own business, but is actually, almost all the terms and conditions are dictated by that large corporation. And so that is what this Biden rule is hoping to cut down on and hoping to prevent, and to make sure that workers get all of those protections that the laws provide. And in relation to flexibility, often people, the gig companies sort of put it out there that what we offer is flexibility, and people want flexibility and they can't have that if they're employees. But that is actually not true. There's nothing in the law that prohibits employers from providing flexible work schedules to employees. And in fact, there are employers that do that.
Terry, to what extent can this be enforced? Or I guess the question is, how does enforcement look like? in this particular case when you consider how wide and how big the gig economy is today?
Well, we certainly do need a lot more enforcement resources than we presently have. The U.S. Department of Labor Wage and Hour Division, which enforces the minimum wage law and overtime, as well as child labor and other laws, only has around 700 something investigators for the entire country, which is around 400 fewer than they had in the late 1970s. So we really need a lot more enforcement resources. State and local enforcement agencies are also similarly under-resourced. At the same time, they can still take action and make a big difference in this area. For example, as I wrote about in the op-ed, Denver Labor, which is a city and county labor enforcement office in Denver, Colorado, recently issued citations to 2 gig companies that were hiring workers. It was astonishing to me when I learned about it. They were hiring workers in restaurants, doing jobs like prep cook and busboys and dishwashers, hiring them as independent contractors instead of as employees. And again, if you go back to what these laws, what this means, it means those workers don't have the right to minimum wage. If they're servers, they don't have a legal right to get the tips people have left for them. They don't have a right to a safe workplace. These are very serious deprivations of people's rights. And the notion that a dishwasher in a restaurant is running their own small business is kind of, ludicrous on its face. And to me, and why I was inspired to write the op-ed in the New York Times is that, this sort of shows the spread of this model to far beyond drivers or delivery workers or much higher paid knowledge and creative workers to really areas where we've never seen it before: restaurants, warehouses. I found websites doing some Googling where there were healthcare apps that were hiring nurses, hospital janitors. There's an education app that bills itself as being like DoorDash, except you get to work with kids. And so you just see this spread throughout the economy. And it's really concerning when you think about the fact that it means that workers, by doing this, companies are trying to ensure they don't have to pay minimum wage or, comply with the laws that every other employer has to follow, including our tax laws as well.
So Terry, it sounds like this sort of using this sort of veil of flexibility to cover not having to really pay and protect some of these workers. I do want to ask you about some of the pushback that you've seen from some businesses, also from a Louisiana Republican lawmaker, saying, look, millions of workers would lose earning opportunities. There'd be confusion on the rules, I guess, depending on which state or vicinity that you're in. And that means lots of lawsuits. And all of that ends up really costing these companies, and as they're painting it, costing the workers as well. What are your thoughts on those arguments? Do they hold water?
I don't think they hold water. We have some our labor and employment laws are really, a bare minimum floor protection for people. The notion that businesses need to be excused from the minimum wage law or from payroll taxes or from unemployment insurance as a condition of operating, that's just problematic to me. We've passed these laws. Legislatures have passed these laws. We as a society agree that workers do deserve some basic minimum level of protection. And frankly, a lot of, most companies and corporations throughout US history and presently in the economy manage to operate using employees and following those laws and paying their taxes. And it is not the only way or rule of nature that this is the only way for businesses to flourish and prosper and to be profitable.
Terry Gerstein, NYU Wagner Labor Initiative Director. I appreciate you joining us today. Thanks so much.
Thank you so much.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Labor shortages subsiding, but still top of mind. Just 4% of CEOs are making return to office a top priority in 2024. That's according to a recent survey by the Conference Board. So where do we stand with the state of remote work right now? Because it seems kind of messy. Yahoo Finance contributor Kerry Hannon is here to tell us. So Kerry, we have a lot of data behind us now. What have we learned about the return to office and remote work and how CEOs are handling this?
Oh my goodness. Thanks, Rochelle. This is really, it is just messy. Like you said, there's on one hand, on the other hand. So we have these CEOs saying, hey, it's not our number one priority this year. Just a tiny percentage, as you mentioned, say it is. Their big priority is to hire and retain workers. And that is the truth. Like even how the job market is today, it's still a tight hiring market, and it's imperative that they make it really attractive to want to work at their company. So although we're hearing all kinds of noise on the other hand, right, a lot of the big corporations have said they're cracking down on getting people back in the office. They're checking their swipes when they come in the door. And it's concerning. But in fact, they're not really saying 5 days a week. They're saying more like 3 days a week. And what do we call that? We call that hybrid working. And so in my opinion, hybrid work is here to stay. The genie is out of the bottle. There are two studies that came out from the University of Pittsburgh that found that, in fact, remote workers don't ding productivity at all. And so did the Federal Reserve Bank of San Francisco. They couldn't find evidence that people working at home hurt productivity or even helped it. It was just it's a zero game here. And so the thing about the University of Pittsburgh one, though, is they found that even though it didn't hurt productivity and performance, it did hurt job satisfaction. And that's something employers do not want to have happen, because it's imperative that they retain workers and keep them happy. So I think we're seeing this really delicate dance about how do we make this work so everybody is happy.
Kerry, what does it mean for companies that are hiring? For years since the pandemic, we've been talking about who holds the leverage, that employers or employees in many ways had a little more negotiating power because the companies needed to fill those roles. Who has a little more power right now when it comes to flexibility or asking for flexibility?
Yeah, Kiko, that's a good question. I think it is evened out a bit, but I do think workers still have some, if you are a knowledge worker and you're a white collar worker and you've got the experience and the skills, I think you have leverage. If you are attractive to that company and you can provide something that they are having trouble getting someone to do, you are attractive to them, as is retaining you. Now, I have to add here, though, other studies have been coming out that sort of kind of give us a murkier look at this. They say that, company hiring managers and managers say, the people who are working remotely, they're not getting promoted as quickly. They're not getting paid as much as those who come in the office. And in fact, they're more likely to be the ones that are lopped off if there's a layoff, because they don't have this personal eyeballing relationship with someone. So it's easier they're expendable in a way because there isn't that personal relationship of being in the office with someone. So those are some dangers, some red flags workers need to think about. But I want to add one more thing. And I've talked to a lot of workers out there right now, and the younger workers really do actually want to come in the office, a lot of them, and particularly when they're starting a new job, and a lot of even older employees who are starting at a new job. And we've seen a lot of career transitions, new movement in the job market, that they in fact really do want to come in to kind of learn the ropes, to make connections, to build their network, and actually learn a little bit about the mission of their employer. So I think we're seeing some interesting trends still percolating up. Nothing is set in stone at this point.
Nothing set in stone, indeed. Appreciate you breaking that down for us. Yahoo Finance reporter Kerry Hannon, thank you so much.
Thanks, Michelle.
All right, well, let's get your final check of the markets as we head into the noon hour. Looking at green across the board here, but only the Nasdaq currently at session highs. The Dow and the S&P just slightly off their session highs. The Dow currently up, but just relatively flat, about 5 points. The S&P 500 up about 6 points so far. And looking at the tech-heavy Nasdaq, of course, ahead of this very big week of the Mag 7 contributors coming up in earnings, it's currently up about 0.33% so far this morning. Well, that does it for now. I'm Rochelle Akufo alongside Akiko Fujita. Stay with us on Yahoo Finance.